Combustion engines get electrified.
This is a company based in China whose activities are overwhelmingly centered in China. That being said, we always are monitoring global markets, obviously from the Department of Treasury primarily, including the assessment of any risk to the U.S. economy, and stand prepared to respond appropriately if needed. But that monitoring would happen primarily from the Department of Treasury.
Jen Psaki there on the story of the moment, the White House press secretary from New York City this morning. Good morning. Alongside Tom Keene and Katie Lyons, I'm Jonathan Ferro. Here's the price action. It's a bounce back from the biggest one-day loss since May. The bounce back looks like this. It's turnaround Tuesday, up 35 on the S&P, advancing 0.8%. Yields in yesterday, higher this morning, up 2 basis points to 132.77 as we kick off a two-day Fed meeting. It concludes tomorrow with a news conference with Chairman Powell and full coverage on Bloomberg TV and radio. Euro-dollar positive by 0.1%. Positive there, a stronger euro, 117.38. And let's get to the story of the moment outside of the story of the moment. It's travel. Travel. You can come back to America in early November if you're European. In Europe, in the UK and elsewhere, you are welcome if you have been vaccinated. IAG, the parent company of British Airways, up more than 4% and absolutely flying over the last 5 days, Tom. Excuse the pun.
Yeah.
Finally, we start to open up travel back into the United States of America.
I was in a watch store yesterday, John. They sell Timex and a few other brands, and they said this will have a profound effect on their business. They were ecstatic over those headlines that we saw yesterday. We come to you today from Greenwich, Connecticut, and in New York, with so many eyes on Washington in the fractious politics. I've got to go first, Joe Matthew, to what John has been following, which is the travel. What is the...
Hello, traders. How are you doing today? I'm going to place order to buy British pound. Please copy this trade for all our clients, our customers, and place an order to buy at 136.844. Okay, order placed. So you still have time and chance to trade British pound. Okay. For not our clients, you can get, if you are not yet our client, you can get the strategy and start following my trades and learn to trade like we do. Okay? Stay safe, and I'll speak to you later after we'll get filled. We still, no, we didn't fill yet. We still, okay, position open on British pound at 136.844. Well done, guys. I'll speak to you later.
This White House here. Indeed, the president will try to shore up alliances, but he will also go out of his way to make the point that we are not about to enter a Cold War with China, that climate change is something, for instance, that we can work on together. But President Xi is not in New York, and it's very unclear exactly what the president's going to lead with. I'll tell you what, though, just look at how he's bookending the day, Jonathan. He's got a bilateral meeting in the morning with the president of Australia, and after he comes home, he's sitting down at the White House with Boris Johnson, which speaks a lot to the priorities of this White House.
Joe, you know how scripted these events can be. You know far better than I do. Are there any deliverables set up for this event?
Actually, it's really quite remarkable, again, that the president will be leaving at 2 o'clock in the afternoon. Sure, he spent the night, but normally there are all kinds of sideline meetings. Some of them are spontaneous. They bring in the press pool. You get a couple of cuts. That's not going to be the case today. It's the one sit down with the president of Australia, and then it's back home to Washington, D.C., where he'll sit down with the prime minister of Britain. This is going to be a brief trip. It's his first speech here. You could say the stakes are high, but it's unclear exactly what, if anything, the president will lead with. He's got to come back here to deal with some major domestic issues that are cooking on Capitol Hill.
Yeah, well, Joe, let's pick up on that point. You have Chuck Schumer and Nancy Pelosi trying to tie together the debt ceiling with a stopgap spending bill in order to prevent the U.S. government from shutting down. If that doesn't work, is the blowback greater for those Democrats or for Republicans?
it's kind of right where we have been this whole time. It's really interesting. They could have come up with this deal a couple of weeks ago. I understand that there will be a vote today. The Rules Committee will finish its work in the House. They'll have a vote on this continuing resolution, and everybody knows it's DOA in the Senate. So there's an opportunity here for Republicans to weigh in, and they're going to say no. They've been in lockstep with their leadership on this, but Democrats want to hang the debt over Republicans. The line that we got from Chuck Schumer was, this is the ultimate dine and dash, a dine and dash of historic proportions. But Mitch McConnell says, no, I'm not changing my tune here, and at some point, Democrats will likely have to go it alone, either through reconciliation or some other standalone bill that we don't know about yet. Fact is, they need to pay for this government starting in 9 days. So the clock is ticking. They don't have a lot of time to figure this out.
Hey, Joe, great to catch up, as always. Always good to hear from you, sir. Good to see you. Joe Matthew there, Bloomberg Washington correspondent and host of Sound On Bloomberg Radio. A little bit later this afternoon at 5 p.m. Eastern Time. I wish we had the pictures of this. We'll try and bring them to you a little bit later. Katie Lyons, the Brazilian leader, outside of a New York City pizza joint in the last 24 hours.
He's here for the United Nations, but he is unvaccinated. And the rule here
so he can't go in
New York is you have to present your vaccine card or a picture of it in order to enter and eat indoors at a restaurant. So he's still got his New York slice. He just had to eat it outside on the sidewalk.
There's no diplomatic immunity?
Nope.
To go into those restaurants, nothing at all. TK, wouldn't it be nice just to sit down with the Brazilian leader here in New York City, have a slice of pizza? We could do a program, or picture this, a table for two on the side of the harbor in Greenwich, Connecticut.
Yes.
With the moon shining brightly.
Well,
an empty seat waiting for
it's
the man you love and
beautiful.
adore, Jonathan Ferro, on the other side of you, just taking in the surroundings of a beautiful morning in Greenwich. Tom, it looks so romantic.
And it's a full moon, and it's Chinese Moon Festival today. We're celebrating it here. We've been having shots of vodka starting at midnight, but it's mooncakes, John. We're having mooncakes here, brought to us by Dunkin' Donuts, and we have a beautiful full moon.
I miss you. I'm pleased you're not cheating on me, and you're keeping that seat empty.
You should have come.
Thank you. You know there's going to be some memes about this now, TK. That looks real lonely, that picture. I can't wait to see what people do with that on Twitter in the next 30 minutes. Can we take the picture again, just to give them the opportunity to cut it? Let's take the picture again. Oh,
yes, that's true.
Look at that.
Where's Emma, Tom?
Look at that. That's special. That is special. Are you saving that for Raducanu, TK? Tom Keene, Katie Lyons, Jonathan Ferro, Lisa Brown is back with us in a couple of days. Equity futures this morning up 38, advancing 0.9%. Yields higher by a couple of basis points. TK, it looks so lonely. I'm with you, buddy. From New York City this morning.
You wouldn't believe what they charged me to park the Grand Banks.
From New York City for our audience worldwide on TV and radio, this is Bloomberg Surveillance. It is turnaround Tuesday and this equity market up 37 on the S&P, advancing 0.9%, bouncing back from the biggest one-day loss going all the way back to the middle of May. Right now, Nasdaq futures up 0.7%, the Russell up by 1.29. There's a ton to get through this week. We're not there yet. The Federal Reserve decision tomorrow, two-day meeting begins today, then on to Thursday when some interest payments are due on some Evergrande bonds. We still haven't dealt with that. So this really is a snapback, just a little bit of a bounce back from yesterday's big move lower. Switch up the board, it's a similar story in the bond market. 2s, 10s and 30s. Yesterday yields in, haven demand. We reversed that a little bit this morning, yields up by a basis point or two. Steeper curve, 132.60 on 10s, 30s up 2 or 3 basis points on 30s to 187.26. Just outside of this story, let's spend a little bit of time on what's happening elsewhere. Switch up the board and get to the airlines. Over in Europe, take a look at this. IAG up by more than 3%, Air France up by more than 2%, Lufthansa up by more than 3%, IAG, the parent company of British Airways, up 25% in 5 trading sessions. And the news yesterday that this country will reopen things for foreign travelers if they are vaccinated, just unlocking, Tom, a big rally in those really badly beaten up airlines. This has been shut now, TK, for what, 18 months? Americans have been able to go over to Europe. There hasn't been any reciprocation. Now we have it. We unlock that story, that one part of the cyclical trade at least, once more.
Well, it says, John, you and me at Tottenham, Manchester United, I believe on October 30th. We'll be able to take that in, no question about that. On a better economy, the dynamics of our GDP, and particularly the dynamics of our inflation, it is an acute team at the OECD in Paris. Laurence Boone joins us now, their chief economist, with a very trenchant report about where we are and where we're heading for 2022. Laurence, wonderful to catch up with you again. I want to go to the French and transitoire. How transitoire is our inflation as we move forward?
Thank you. It's really nice to catch up with you again. Thanks a lot. So, transitoire means 3 things in English, if you allow me. The first one is we have a lot of supply bottlenecks that is due to the fact that the world is not being vaccinated enough. So if we vaccine, that should go away. Transitoire also means that we have a surge in demand. As you know, we had a lot of fiscal support, and that's, we've passed the peak, and that means it will also fade away. Now, what we need is some more clarity about how policymakers are going to deal with inflation expectation. But so far, that's what transitoire is, well into the beginning of 2022.
I look, Laurence, at the report, and it is a report of optimism. We see market economists tweaking here and tweaking there. What is the element of economic growth that is most mysterious for 2022?
There are a couple of things that are very mysterious for 2022, and more than that, actually, in economics. There's a lot of uncertainty, as you know, out there. One, again, is the vaccination. As long as we won't have vaccinated the planet, the risk of a variant that's nastier is possible, and that would pull us back into 2020. With all restrictions on economic activity. Another huge source of uncertainty is obviously inflation expectation, and we'll need both central banker and fiscal policymaker to give clear trajectory on their tools, on the budget, on monetary policy to make sure that those inflation expectations we were discussing actually remain anchored. And that's at least two uncertainties. I'm sure you've got many other.
We've got a ton, so let's weigh in on a few more. But let's start with inflation and just build on your forecast. So you've hiked 21-22 inflation forecast, the outlook for the US, the Eurozone, and the UK. Can you run me through the policy prescription you offer alongside that? You were talking there a little bit about guidance, Lawrence. I want to understand the policy stance that you'd like to see from central banks together with that story, with the inflation outlook.
So thank you. I think these are two very interesting questions, actually. In the short term, for advanced economies, and the one you mentioned, it's pretty clear we're not back on track yet, not fully, right? So we still need those policies, monetary and fiscal, to be accommodative. But we know that, we're getting closer to the trend we had before COVID crisis, so these policies will have to evolve. And there's no one size fits all, but what we need is at least two things. First, indication on the sequencing, and second, indication on the conditions, the economic variables, the evolution that will make those policymakers move. And the last thing is, fiscal policy, super accommodative, will not last forever. We have climate to address. This will require resources. So governments need to plan now on how they will adjust in the future, in a year or so, for addressing those challenges.
Let's talk about China. Laurence, I'll be blunt. What on earth is going on in China right now?
So the Chinese authorities, as you know, for a while have been trying to rein in the loans that support the real estate sector. And we've always been their excesses. We've always been, they need to be reined in. It's rarely a very smooth ride when regulators are trying to adjust some of this excess credit. That's one thing. The really important things that you want to look at is what's the possible contagion effect on the rest of the world economy, right? And for this, I think, notwithstanding the fact that it's very early to be able to assess that, when we look at this in the past, on the real economy side, you need a prolonged shock in China to have an impact on the rest of the world. And on the financial side, there's still too few connections between China and the rest of the world to make us overly worried, but it's obviously a risk that we are monitoring.
But China obviously could have an outsized impact on emerging markets specifically, even if not so for developed markets like the U.S. Does what's happening there risk exacerbating the inequality of growth that you reference in this outlook?
Well, this is right. I think a number of emerging markets are very sensitive to China. Just look at commodities, right? I mean, there's a lot of commodities that are being exported to China. And you can name a few of them, especially in Latin America, for example. So yes, a prolonged slump, which would have downward impact on those exports of commodities, would definitely harm them. And we do say in our projections that some of the emerging market economies are more fragile than others.
Obviously, part of what is happening in China as well is an effort toward decarbonization, and that is leading to lower steel production, for example. And we have the UN meeting here in New York this week with climate-related issues really front and center on the agenda. And I'm wondering how you factor that into your growth and inflation expectations when you think about some of that decarbonization effort.
So I think you've pointed the finger on what's the next biggest challenge, and one of the reasons why we are insisting that fiscal policy must, enter into some kind of guidance, like what monetary policy has been doing for now more than a decade, is also because of the cost of the climate transition. I think we should be true to ourselves. This is going to be costly, and it's going to be costly for public finances, and we will also have to look at the impact on inflation. Take, for example, Spain. A huge chunk of the upward revision we've made is because of electricity prices. But what's important to note is it's a shift in the price level. It's not a permanent shift in inflation. And that, I think, is the message we were also trying to send this morning with our update.
It's the message Chairman Powell's trying to send as well. No doubt he'll do the same tomorrow, perhaps. Lawrence, great to catch up, as always. Thank you for being with us today. Lawrence Boone there, OECD chief economist. Your equity market up 37, bouncing back 0.9%. One single name to watch right now, at least. Some news in the last couple of minutes, Kaylee, on Uber.
Yeah, Uber says it's now tracking toward an adjusted EBITDA break even in the third quarter. That would be the first ever profit for this company. Remember, it once reported a quarterly loss of $5.2 billion. This seems to be primarily due to a gross bookings recovery as we emerge from the pandemic here, John, but you are seeing a big spike in the shares in pre-market trading. They're up about 4.8% before the bell at the moment.
To 41.70. Bit of news out of J&J as well, TK. Let me bring it to our audience. This from our colleague, Robert Landgraf. A booster dose of J&J's COVID-19 vaccine provided 100% protection against severe disease when given 2 months after the first inoculation, according to widely anticipated data that suggests it increases the potency of the one-time shot. Bit more news, Tom, on the vaccine front.
Yeah, and what's important there, John, is a drip of it. I mean, the Angst crew has some real worries. They're tangible. We are now up to the deaths in the pandemic that we saw in 1918, and that's an important statistic. But far more, John, is this story, that story, now the J&J story showing science is working.
Looking forward to catching up with Amish Adalja, the Johns Hopkins Center for House Security senior scholar.
Yes.
We'll catch up with him in around about 5 minutes' time. If you're waking up this Tuesday morning, good morning to you all worldwide. This is the story right now for U.S. equity markets. It's a snapback, it's a bounce back, a relief rally, a turnaround Tuesday. Call it whatever you want. Equity futures up 36 on the S&P, bouncing back from yesterday's big losses on the S&P 500, up 0.8%. Yields turn around too, up a couple of basis points to 132.60 on 10s. Let's call it 132.80 now. And in the commodity market, crude firmer too at $71.12. TK,
over.
This week isn't over. Never mind the crisis. We've got a Fed tomorrow, Tom. And interest payments due on Thursday for those Evergrande bonds.
We have Fed Day tomorrow?
We've got Fed Day.
Fed Day is tomorrow?
You've got to come back tomorrow.
I didn't know that.
You're not allowed to stay out there tomorrow. Two-day meeting begins. You and I are going to lead some coverage tomorrow on a Federal Reserve decision and, I believe, bonus round with Katie Lyons. Because Lisa Bramage decided to skip Fed Day. She's skipping Fed Day, Tom. She enjoyed yesterday so much with the market down. She thought she'd take today off with equity futures up 0.8%. From New York City this morning, good morning. This is Bloomberg.
Fast Word News, I'm Rishka Gupta. New data show that a booster dose of Johnson & Johnson's coronavirus vaccine provided 100% protection against severe disease when it was given 2 months after the first shot. J&J is joining rivals in showing the benefits of a booster shot. The J&J vaccine is given in a one-shot dose, unlike the two-shot inoculation of other vaccines. In Canada, Prime Minister Justin Trudeau faces the prospect of another fragmented parliament. Trudeau won a third term in the snap election, but his Liberal Party fell short of the majority he was seeking. That means he'll have to rely on smaller parties to pursue his left-leaning agenda. For a second straight election, Liberals lost the popular vote to the Conservatives. House Democrats are taking a risky move that assures a potentially damaging showdown with Republicans. They will include a suspension of the debt ceiling in a spending bill needed to keep the government open past the end of the month. Republicans have already said they won't vote to raise the debt limit. All this could be leaning towards a government shutdown at the end of the month. FedEx plans to raise its delivery rates next year by the most in at least a decade. The average cost of package delivery will increase 5.9% at both the express and ground units. Some freight rates will increase by almost 8%. Transportation costs have been rising because of strong demand combined with higher wages for drivers and warehouse workers. Shares of Universal Music Group soared by as much as 43% in their stock market debut today. UMG was spun off from French media company Vivendi. The stock began trading days after the U.S. recorded music sector reported strong sales growth driven by a surge in streaming audiences. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
at China, if you look at U.S. taxes, how much time do you spend figuring out these big overarching themes as opposed to what happens with inflation?
There's an awful lot going on at the moment, as you say, and clearly some of the big debates at the moment are the slowing global growth picture, which we're seeing everywhere. And we're also seeing that at a time when inflation is rising and is proving pretty sticky. And to your earlier points, Francine, essentially the interplay between those two is critical. So some of those news events this week, whether it's OPEC and what's happening from a supply perspective, is going to be crucial, or indeed, of course, that US CPI print. So we've spent a lot of time thinking about inflation more recently, because clearly that leads into when we feel you may start to see the taper and when you might start to see rates going back up, particularly in the US. I mean, what might be useful just to explain a little bit is the focus that we've seen from everybody on China. You know, clearly China, huge in terms of the global commodity cycle.
From New York City.
We're in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics?
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Getting the whole world vaccinated is not just an altruistic effort. It is also a strategic effort. If we want to stop variant development, it's not just in this country, but it's around the world where we have that ongoing uncontrolled transmission. That's where you're going to see new variants. So a variant anywhere in the world today could be everywhere tomorrow.
Michael Osterholm there of the University of Minnesota from New York City this morning. Good morning. Alongside Tom Keene and Katie Lyons, I'm Jonathan Ferro. Here's the bounce back in your market. Equities are firmer. They're higher on the S&P 500, up 35, advancing 0.8%. This is a turnaround. Basically, yesterday turned upside down. Same in the bond market. Yields higher today, lower yesterday, up 2 basis points to 132.77 as we kick off a two-day meeting for the Federal Reserve. Tom Keene out in Greenwich, Connecticut. TK, I've got so much runway to play here. This shot, can we take this shot again? It is just beautiful of Tom alone at a table for two. Tom, you know that song by Akon?
It's great.
Lonely. Do you remember that years ago? Yeah. If we could just play that.
Yes.
Going in and out of commercial break, that would be beautiful.
This photo describes my social life. Just so you know right now, this image, it's really, Lisa was going to come, but she had to do something.
She left that seat empty.
We will see.
You carry on, Tom.
The Greenwich Economic Forum, Nora Rubini will be with us and Ray Dalio, among others. Governor Lamont, I've got a lot to talk about the governor of Connecticut and taxes across this nation, and we'll do all that here across Surveillance this morning. I have a grandmother born in 1907, and she would regale us with stories of the pandemic in 1918, and for 25, 30 years, of our privilege of being with her, we said, so what? The so what in the new humility is this pandemic of 2020. Amish Adalja joins us now from Johns Hopkins. And Amish, this is a day where the Washington Post states it's 675,000 Americans. We have as many dead as the pandemic of 1918. Our population is bigger. It's 1 in 150 dead versus presently 1 in 500. Compare the virulency of this pandemic with what you studied of the horrific influenza of 1918.
Certainly, if you look at the viruses pound for pound, I would think that the 1918 flu virus has a higher mortality rate, just in sheer numbers, if you were to be infected. But what I think is most significant is in 1918, they didn't have modern hospitals, they didn't have critical care medicine, they didn't have antibiotics, they didn't have any knowledge of the knowledge that we have of infectious disease. In 1918, they didn't even know that influenza was caused by a virus. The virus wouldn't be isolated for about 2 decades longer. So the fact that we're approaching the sheer number of deaths now in 2020, 2021, when we have antivirals, when we have vaccines, when we have modern critical care, when we have tests, when we know so much about the biology, that's really inexcusable. We shouldn't have 1918 level pandemics. Because of all the tools we have. And I think that's the lesson, that we made this as severe as it was. That was the human factor that expanded the ability of this virus to kill.
Dr. Adalja, they did not have our social and less than social media. Were they advantaged because they did not have the messaging of the unvaccinated?
Well, they didn't have a vaccine at that time for flu anyway, but it was something that did have a lot of controversy, kind of not the same thing as social media, but there was censorship going on. Because remember, World War I was occurring, and many of the countries that were involved in the war had their press kind of unable to write about things that were considered to be unpatriotic, and the flu was considered to be unpatriotic. The reason why it's called the Spanish influenza is because Spain was not really involved in World War I, and their press was free to write about it. So I do think they had some misinformation about how bad it was, but they didn't have people that were kind of making up lies about it. There were anti-mask leagues, there were protests against masks when they occurred, but I don't think that we saw, the voice of the Dark Ages hijacking 21st century technology to spread myths and misinformation, and that's what we have in this pandemic.
Dr. Adalja, we had news crossing earlier this hour from Johnson & Johnson, which said a booster shot of their vaccine provided 100% protection against severe disease. Should we be treating a J&J booster differently than we're thinking about boosters for mRNA vaccines?
Not necessarily. What we want to see, again, is more data. This was a press release, and we knew that Johnson & Johnson was conducting a 2-dose study, because there are some people who have argued that maybe the Johnson & Johnson vaccine should be a 2-dose vaccine, just like the Pfizer, the Moderna, the AstraZeneca. And this is data showing that perhaps that is the case, that the protection, which is still very strong against severe disease that you get with 1 dose of Johnson & Johnson, can be increased by making it a 2-dose regimen. We'll have to see what the actual data shows. We'll have to see what Johnson & Johnson plans to do in terms of going to the FDA to either modify their vaccine to make it a 2-dose shot, or to say we need boosters at a certain period of time. But again, this is a debate that will play out over time with the FDA, with the CDC, ACIP committee, and actually with the data.
Another debate that has played out over time is the debate around travel restrictions for those entering the U.S. And there's a question on the timing of the U.S. announcement yesterday that those from Europe or the U.K. could come to this country if they are vaccinated, whether it was geopolitically driven or scientifically driven, given it comes at a moment when we are dealing with another surge. Do you think it was a scientifically sound decision to make this announcement now?
I do think it was scientifically sound. Travel restrictions don't keep viruses outside of borders, and we know that from the very beginning, that when there were travel bans in place, the virus was already spreading within the United States. And we have a lot of technology, not just the vaccine, but rapid tests. We know how to take care of people that come in from a different country to make sure that they don't harbor the virus with testing. And Americans are going all around the world using these tests to get into other countries. And I think this is something that is long since coming. I think that this was something that we could do with testing, with proper knowledge of people's vaccination status. So I do think that this is a good step forward, and something that I think should have been done a little bit earlier. Doctor,
a lot of people agree with you. I won't give my personal view. I think everyone already knows that one. Doctor, thank you. Dr. Amish Adalja there, Johns Hopkins Center for House Security Senior Scholar. TK, I will be fascinated in the coming days to start getting some little pieces of data from the airlines to see how much bookings to America absolutely exploded in the last 24 hours. I can tell you the first thing I did yesterday afternoon, got on the phone to the family. Tom, going home for Christmas, straight away. Book the flights.
It'll be interesting to see the dynamics of what it means to their profitability as well. I had a ratio, John, on business class versus economy of well out over $6 to 1. I've never, ever seen that, the demand for business class. And you really wonder, with this huge demand, does economy finally really pick it up?
There is a big hole to climb out of, that's for sure. IAG this morning, over in London trading, up by a little more than 3%, the parent company of British Airways. Elsewhere, here's your market. If you're waking up stateside this Tuesday morning, we have the turnaround that many of you anticipated. This week, though, is far from over. These issues are far from addressed. Up 37 on the S&P, up 8 or 9 tenths of 1%. This from S&P, Standard & Poor's, overnight, Kaylee. Evergrande to likely default, not get any direct support. Here's the quote. We believe Beijing would only be compelled to step in if there is a far-reaching contagion causing multiple major developers to fail and posing systemic risks to the economy.
Yeah, and S&P running counter to what we've heard from a number of strategists who say China and Beijing will indeed step in here, that they will not allow this to happen, not allow it to be China's Lehman moment, Tom.
Yeah. John, do you know what I just learned?
What's that, Tom?
John, the market never goes down in Greenwich, Connecticut.
Oh, is that right?
I didn't know that.
You just found out?
It's amazing.
You're going to catch up with Ray and talk about that a little bit later, Tom. Did Ray Dalio tell you that?
It never goes down.
Ray Dalio of Bridgewater coming up with Tom Keene a little bit later this morning.
We will open on Bridgewater.
Yeah, looking forward to that. Jason Draho of UBS coming up shortly. Your equity market up 0.9%, staying on top of the markets right here on Bloomberg.
There is just a lot of demand right now for products, whether those be items for our home office or for backyard entertainment. This has been a consistent issue for the past year or so throughout various lockdowns. The global supply chain is made up of ships and trains and trucks, and it's designed for predictable patterns of demand, which is the exact opposite of what we have right now. A lot of uncertainty about whether certain economies are going to be open or closed based on the outbreaks that they're having. So we're just seeing a lot of confusion, a lot of chaos, and a lot of uncertainty disrupt the whole system. The auto industry is very reliant on semiconductors, these memory chips that are in basically everything we buy that has sort of an electronic component to it. And they come from certain economies in Asia like Taiwan, where they're having trouble meeting the demand. The supply chain issues are going to be around as long as you think the virus is going to be around. First or second quarter of 2022 is when a lot of people see the normalizing of all the shipping and transportation disruptions that we're seeing. But if they don't, we might be dealing with this for another year or two or three.
Wednesday, Bloomberg surveillance. The Fed decides. When will tapering begin? How does the Fed see the Delta variant economy? Coverage begins at 1:30 p.m. Eastern on Bloomberg Television and Radio. A lot's happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Want to see a down market, but I do think that this is just a natural part of the process.
I think it does matter, the tightness that you're seeing in product markets, if it continues for a longer period of time.
If inflation expectations get unanchored, that's going to push inflation up.
The risk that we're mostly unhedged for
Is this rise in inflation?
All of these economic interdependencies just look increasingly like weaknesses, and that's what we're seeing.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
Oh, this week is getting interesting. From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene in Greenwich, Connecticut. I'm Jonathan Ferro here in New York City alongside Katie Lyons filling in for Lisa Abramowitz. That's a mouthful. Equity futures up 37 on the S&P 500. This is your bounce back, up by 8/9% Tom Keene off the back of yesterday's big slide, and this week is far from over.
Big recovery at the very end yesterday, a nice pickup, and we follow through this morning as well. John, as you mentioned in the last hour, the correlations here are really absolutely critical. The idea of what bonds will do, what curves will do, and I'm particularly watching the real yield now under a negative 1.00%, a lesser negative statistic. It'll be interesting to see how that performs in a better stock market.
Nominal yields this morning up 2 basis points to 132.77, Tom. I'm looking forward to hearing you frame the debate out in Greenwich, Connecticut. Walk me through the lineup through the next couple of hours.
Well, the lineup here is really, it's varied, but I've got the governor of Connecticut, and of course that's front and center on tax policy in a heavily taxed Connecticut. Okay, fine. But what I'm really interested in is Noah Rubini and the interdependencies given the credit markets we're in. And this goes to Barry Eichengreen's new book out of Berkeley. And then Ray Dalio, Catherine Burton has done phenomenal reporting on Bridgewater for Bloomberg. We will talk to Ray Dalio about underperformance. We'll talk to him about the struggle at the zero bound, John.
And no doubt we'll find some time for a little bit on China as well. Katie, how many times we heard it this morning? China. Is it worth repeating? It's not Lehman. It's not Lehman. How many people have told you that?
Our colleague Danny Berger actually tweeted a chart on the story count with the word Lehman, and it is a huge spike upward on the end of this chart. It's a very interesting question, John, as to whether or not we're actually going to see China intervene ahead of that Thursday deadline, those bond payments coming due for China Evergrande. And there's a question, John, of if China sneezes, if this Evergrande potential default that S&P warns about has ripple effects throughout the property sector within China, China heavily weighted within global GDP, is the rest of the world going to feel it if China sneezes?
Certainly, on the economic front, on the financial front, most likely too. Barclays, though, on the Lehman moment. So is this China's Lehman moment? Not even close. That's their line. A lot of people agree. This is the market setup this Tuesday. Let's whip through it together. We'll work through these markets through the next couple of hours live on Bloomberg TV and radio. It's a market that is fascinating right now. The global economy at some kind of inflection point, policy at some kind of inflection point, and Evergrande really up against the wall. Equity futures up 35, advancing 0.8%. Yields higher by a couple of basis points to 132.77. This is what a little bit of relief looks like. And in the FX market, euro dollar positive by about a tenth, Kaylee. Euro dollar 117.34.
My interesting thing is we're still at 132 on the 10-year yield. We've been within this 130, 135 range for what seems like a very long time, and I wonder if tomorrow's Fed decision is going to be one of the last catalysts for us to break out of that range in 2021. Now, maybe we'll get a catalyst in terms of economic data as well at 8:30 a.m. Eastern time. We're going to get housing starts and building permits for the month of August. I expect that builders are still going to show dealing with supply issues from labor to raw materials, but we did have that more positive NAHB home builder sentiment data yesterday for the month of September. So maybe August was the worst of it. We'll have to see what that data tells us. And then later on this morning, of course, it is UN week here in New York. President Biden making a day trip here to Manhattan to speak. He will speak at 10 a.m. Eastern time. I imagine he is going to talk a lot about the vaccination effort, especially now that the U.S. has reopened its borders to vaccinated tourists, et cetera, from Europe and the UK. And finally, watching FedEx earnings after the bell as well, after the company said they are going to hike their shipping rates by the most in a decade due to cost pressures and a challenging operating environment. And to me, higher costs to ship a package just feeds into that inflationary kind of story, John.
Kelly Lyons, thank you. A couple of things to watch through this morning. So, Tom, what's changed? I caught up with Mike Wilson of Morgan Stanley, put that question to him. What's changed? He said the following: price is the most important determinant of people's behavior. Price gets you to focus on the things right in front of you, Tom, all along. It's price that's changed, and price sets the narrative.
On the other side of the bulls who reaffirmed yesterday, they look at technology, they look at the earnings. I know our next guest has that feeling of strength to the year end. But John, what it was an opportunity yesterday, but you've got to pull the trigger given fear. John, I failed. I couldn't pull the trigger.
You couldn't buy, couldn't get out of cash. Maybe you've got to wait,
buy.
Tom. Mike Wilson says it could take a couple of months. Let's see what Jason Draho's got to say. UBS head of tactical asset allocation for the Americas. Jason, walk me through the issues we need to resolve here. How long this might take?
So I would say maybe not quite 2 months. Hopefully it's not 2 months, but it might be more along the lines of like, say 4 to 6 weeks. So, we have to get through, the Evergrande situation, see, how, broad this could be, or does ultimately kind of tamp down in terms of concern. We have to get through the FOMC tomorrow to see, is the Fed going to, end up being a little more hawkish, as some people fear, or do they kind of toe the line? We kind of get through that. Do we get to the debt ceiling? So really the next 10 days to 2 weeks, we see a lot of potential head risks or headline risks that we can get through. I think until we kind of clear those hurdles, I think then people get more comfortable that, look, the underlying fundamentals haven't really changed. The evidence we saw last week suggests maybe the summer slowdown has been, is over, and we can get a bit of reacceleration going into year end. If that's the case, then once we get through the kind of these event risks, then that fundamental story kind of will resurface. I think same thing with the earnings. A lot of fear about 3Q earnings. If they turn out to be not so bad, I think that gives people comfort that ultimately the fundamentals are okay, and that sets us up for, I think, more strength going into year end.
Jason, on a tactical basis, within tactical asset allocation, what is the most efficient way to deploy cash out over the next 100 days? How do you actually tactically do it?
Well, it depends on exactly what your baseline allocation is, right? So you talked about, you couldn't pull the trigger and buy yesterday. I'd say in our portfolios, in our allocation, we are kind of overweight risk. So for us, it's a situation where I'd say we don't want to pull the trigger and sell. So when you do get these pullbacks, the question is, well, relative to your allocation, should you be adding more risk? Where do you want to add the marginal dollar? We still think there's more upside in some of these reflation plays, these cyclical stories. The growth concerns have been dominating markets for the past few weeks. It's probably been overpriced in the markets. So leaning a little bit more towards some value stocks that could still do well with like mid-cap, things like that, that are basically leveraged as kind of a global recovery story. So if you want to put $1 to work, that's where I put it to work over the next month or next 100 days. Next, 4 weeks could be choppy, but I think 100 days from now, I think we're in a better position.
Jason, are you making an assumption here that whatever's going on in China is going to stay contained?
So I think the concern I have about China is not so much the contagion risk or systemic risk in the banking system. I think that the bulk of Evergrande's debt is owned by or lent to, basically banks are owned by the state government. We're not going to see a private sector bank run a la Lehman and the way we there. So really the more concern I would have is, does this lead to sort of a slowdown in growth because the property market takes a hit, people become a little bit less confident, and you don't see enough Chinese stimulus from policymakers to sort of offset that. So just from a global growth perspective, do we have to downgrade China's growth that has knock-on effects everywhere else? And therefore the growth acceleration thesis that would have, maybe there's more risk to that, more so than a systemic situation kind of arising in credit markets.
How uncomfortable do you think those longs in Europe are now, Jason, with everything you've just said?
Well, I think the view on Europe has actually become a little more constructive, at least to the margin. And you just to compare it to the U.S. because, as we saw kind of a wave kind of pick up in cases in the U.S. in the summer, it didn't materialize quite as much in Europe. And as we go into the fall, I think there's a little more confidence that perhaps we won't see another big Delta wave as we go into year-end in Europe versus the U.S. That said, European equities a little more globally sensitive as opposed to the more the defensive tilt in the U.S. So you kind of have to balance those two, which is why ultimately we don't have a strong preference between, like, say, European equities versus the U.S.
Jason, what is the most productive way to affect a commodity strategy? If I'm tactically asset allocating, how do I play commodities? Direct stock ownership, ETFs, or do I buy gold bars?
Well, I mean, I wouldn't necessarily buy gold bars. It's not efficient certainly for us, I think for most investors. I think ETFs are an easy way to play it, or certainly the simplest way to play it. The challenging thing for commodities, and this is something we often wrestle with when we think about putting on exposures, what part of commodities do you like? I mean, there's energy, there's base materials, there's precious metals, there's agricultural goods. So which part do you like? Because different funds have different ways in which they weight it. And so it's not all the same. It's not like buying a fund that's going to track the S&P 500. So you have to sort of think, well, drill down, what parts do you like and what funds can kind of give you that exposure? You think about the tax consequences. So it really starts to become a little bit of instrument selection, like how does that best express the views that you have within the commodity space overall. That's the exercise that we go through.
Copper, gold, and crude positive this morning. Jason, got to leave it there. Jason Draho there, UBS head of tactical asset allocation for the Americas. Jason, thank you. Tom, when was the last time on Fed decision week We discussed the Fed so little. Monday, Tuesday, through to Wednesday, we've hardly done a thing on it.
Yeah. John, absolutely brilliant. I mean, it's really been pushed aside. I think it speaks to the press conference. You may get a recalibration by them on how dovish is. But you're right, John. We've never done an into-Fed meeting this silent.
Kelly, do you think this is down to, get my words out, down to communication or down to events that are unfolding right now? I do, Tom. You're away. I'm just inheriting some of those faults. Kaylee, communication or down to events?
I think it may be down to events, John, in that we already had kind of downgraded the importance of the September 22nd meeting following that weak jobs report we got weeks ago. So I think already the Fed this week seemed like it was going to be less of a market event than maybe had been anticipated previously. Then you layer all the risk on China on top of that, and then it downgrades maybe the importance even more, John.
We're going to build up some of the coverage through this morning going into that Fed decision. In the next hour, Tom Keene sitting down with Nouriel Roubini, the CEO of Roubini Macro Associates over in Greenwich, Connecticut. Then a little bit later that hour, the governor of Connecticut. Then, Tom, on to Ray Dalio of Bridgewater.
It's going to be interesting, John. I just figured out while you're stumbling on your words, you got into my tang because I'm not there.
I am. Spike tang. I didn't know, Tom. I thought we were always joking. I did not know that it was actually spiked with your beverage of choice every single morning. Futures this morning, good morning.
Every single morning.
I'll stay in control of my words through the rest of this show. Up 35 on the S&P, advancing 0.8%. The race towards a Fed decision tomorrow. Full coverage on TV and radio. This is Bloomberg.
With the First Word News, I'm Rishika Gupta. New data suggests that a booster dose of Johnson & Johnson's coronavirus vaccine increases the potency of the one-time shot. The booster was 100% effective against severe disease when given 2 months after the first inoculation. A second-day study found that the additional J&J shot led to a 12-fold increase in the production of antibodies when it was given 6 months after the first one. In Canada, Prime Minister Justin Trudeau won a third term in a snap election, but he fell short of regaining the majority he was seeking. That means Trudeau's Liberal Party will have to rely on smaller parties in order to get legislation passed in Parliament. The Conservative Party actually won more of the popular vote than the Liberals. British Prime Minister Boris Johnson says President Biden has too many domestic priorities to find time to negotiate a trade deal with the UK. The two leaders meet today in Washington. A trade agreement with the US was billed as one of the prizes of Brexit. Johnson says he would rather have a good deal than a quick one. Uber once posted a quarterly loss of $5.2 billion. Now the ride-hailing giant may be about to report its first profit. In a filing today, Uber said adjusted earnings may range from $25 million loss to a $25 million profit in the third quarter. The company said that adjusted earnings in the fourth quarter could range from flat to $100 million profit. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
如果佢唔係屬於呢個風險嘅地區咧，就全部由聽日開始咧可以恢復翻回港嘅安排啦。呢個計劃咧就將喺9月15日咧就正式推出，名額咧係深圳灣口岸同埋港珠澳大橋香港口岸每個口岸每日各1000人，咁即係話每天咧 係合共有2000名非香港居民可以通過來港易咧係豁免檢疫咧係抵達香港。
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Angela Merkel, after 16 years in power, actually, remains one of the most popular, if not the most popular, German politician ever. Who's the right person to fill those shoes?
Well, whoever is going to be filling those shoes is going to have a very hard time. Look, as the Merkel era ends, most of the certainties which we Germans, during 16 years of Merkel, tended to take as forever are evaporating before our eyes. The eternal assurance of the United States always protecting us, that's gone out with Donald Trump. The certainty that we will build an ever closer union, the EU, has gone out of the window with Brexit.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The Federal Reserve certainly understands that China is an important player in the global economy. If China had a hard landing, that would have very serious consequences for the rest of the world and for the United States. I think at this point it's really premature to reach that conclusion.
An important moment for this economy, for this market. Bill Dudley there, the Bloomberg opinion columnist, senior advisor to Bloomberg Economics. Here's the price action. In this important moment, we bounce back in the equity market up 34 on the S&P, bouncing back 0.8%. Yields are a little bit higher by a basis point to 132.43. On the hard landing out of China, we spent a lot of time over the last 10 years discussing that. Let's get some forecasts, TK. This from Bank of America, 21-22 forecast for China. They've been lowered to 8% and 5.3%. That's down from 8.3 and 6.2. So far, far less constructive on next year's GDP. And Tom, for anyone in this market, cross-asset worldwide, you've got to start plugging that in. What does a lower growth trajectory out of China mean for your investments?
Well, John, this is brilliant, and it goes back to the landmark work of Jonathan Anderson at UBS 15 years ago. There's something about moving below 6% GDP in China where everyone assumes the domestic political calculus changes. That's the tension right now away from the finance of Evergrande.
That is a full 1 percentage point drop. And Tom, that's why we've been having this conversation. You don't start, is it Lehman? Is it Lehman? And then say no and move on. Is the main risk through the financial channel, contagion, Tom, you mentioned that, or through the real economy? And I think base case for a lot of people has got to be through the real economy at the moment, Tom.
No, it's going to be through the real economy, and it also can come with shipping their exports over to the United States, and that's something we watch very carefully. That's part of the Washington dialogue, and we do that now with Anne-Marie Horton visiting in New York today, certainly for the UN meetings. Anne-Marie, I want to go to how the Washington Post this morning, full front and center, says the Democratic options are diminishing. They are narrowing down in the days. In the next couple days, how critical is it for Speaker Pelosi, Majority Leader Schumer, and the others to find options to choose from?
It's incredibly critical. They are working every single day to try to hammer out these deals. And we should make note that there are different paths of legislation happening right now in Congress. What they are dealing with right now, first and foremost, is what matters for the health, the economic and financial health of the country, and that's the debt suspension of the debt ceiling, as well as the stopgap funding to keep the government opening and operational. What we saw yesterday is the Democrats linked these two bills. That sets up a very risky fight because the Republicans say they will not vote for it. So potentially Democrats are then going to have to go back and try to figure out another way of doing this by themselves, which is just going to take much more time as they try to get through their $3.5 trillion reconciliation package.
What is the power of Senator McConnell of Kentucky?
Well, he was able to round up 46 Republican senators. I say 46 because there still are 4 Republicans who potentially could vote for this. We know of one, Senator Kennedy of Louisiana wants to see what the aid is included in this measure, so he could potentially vote yes on a debt limit suspension because his hard-hit Louisiana from Hurricane Ida needs that aid. But McConnell has made it very clear, and not just to the Speaker and to the leadership, but to Treasury Secretary Janet Yellen, that no Republicans, by and large, will not vote to increase or suspend the debt ceiling.
And if this ultimately backfires and results in a government shutdown, Anne-Marie, that is just yet another hit to the Democrats and to the Biden administration specifically. Is he just at the mercy of Congress for the next week, 10 days?
Absolutely, in the sense that he is relying on his partners in Congress to get this done. I would say that potentially it's a hit on the Democrats, first and foremost, because they do have control of Congress and the executive branch. But at the same time, the Republicans are the ones that are saying that they will not vote in favor of this stopgap funding measure because it's linked to the debt ceiling. So potentially that can harm them as well.
And what it means for the president as he speaks to the United Nations later today, Anne-Marie, what message is he trying to send?
The message is going to be a continuation of what we saw from the president in Cornwall at the G7. The 3 major topics are going to be China. This is about competition, not conflict. I doubt he will name China by name, as you saw similarly with the AUKUS recent submarine deal. They did not mention China, but squarely we all know what the point of those nuclear submarines in the South China Sea will be doing. Second is going to be COVID. They want to ramp up COVID boosters. This fell short at the G7. Remember, the Biden administration was pushing for 1 billion COVID vaccines, excuse me, not boosters, COVID vaccines for the developing world. They got short of that, so he'll recall that again today. And then climate change. Climate change is going to be huge for the president to address, but right now we're going into Glasgow and very unsure about what exactly this COP26 can actually deliver.
Anne-Marie, I can see you up here on the shores of Greenwich. It's great. Breakfast is $142. Anne-Marie, I'm looking over here at the gorgeosity of Greenwich Harbor in the sun. Here we go. Hates the salt tax. Hates the salt tax. Hates the salt tax. Hates the salt tax. The guy up on the hill has so much money, he doesn't care about the salt tax.
Okay.
Anne-Marie, an update on Governor Lamont's salt tax.
Well, I have to say, Tom, it's nice to see you in Greenwich, but you really went to far lengths to try to avoid me today on my homecoming back to New York. The update on salt is they promise they will do something with it. They will do something meaningful. It is still being worked out. That's the update. But the moderates say in the House, especially, and the Senate, they will not vote for reconciliation if salt is not addressed.
Anne-Marie, thank you. Great work as always. Our Washington correspondent here in New York City, not down in D.C., here in New York City for the next couple of days for the UN General Assembly. A little bit earlier on the program, in a previous hour, we took this beautiful shot of a lonely man, a lonely older gentleman sitting alone with an empty seat. And I asked you all to make some contributions, some memes. This is the winner. Tom has a special relationship with a man called Harry. He's 28 years old. He plays for a club called Tottenham Hotspurs. Tom, that is a beautiful picture. Harry photoshopped into that seat. Isn't that just perfect? Stephen Newton, shout out on Twitter. You win this morning. This is beautiful.
And what's great about this, John, and it brings a tear to my eye, is Harry's dressed appropriately casual Greenwich. For those of you on Bloomberg Radio, this is Kane of the Tots. And John, it would be nice if he could put the orb in the net here at some point in the month of September.
Not making it happen. Do you think he's a bit distracted, TK?
Isn't that? I think he's way distracted. He's already got 2 feet out the door. How do you handle that? There's really, John, seriously, there's no equivalent in professional sports in America.
Not right now, there's not, Tom, but I imagine you'll see this scenario play out a few times in your lifetime. TK, put this in a diary. Put this in a diary. December 18th, Tottenham, Liverpool. We can go and make that one.
Harry's got a boat here, John. Larry Silverstein's got 180 feet just over here. And Harry came in with 200 feet. It's some Italian thing out of the Mediterranean.
Is that right? I can't wait, Tom, to hear what you've got to say to the governor of Connecticut on taxes. Given that lead up there.
I want to talk about the speeding ticket I got in 1978 on the Merritt Parkway.
Still not paid.
Really
not paid it yet.
Still like to bring that up. Yeah.
Equities up 34 on the S&P. We advanced by 0.8%. Yields higher by a basis point, 132.60. Nouriel Roubini, 8 a.m. Eastern Time.
Nouriel.
8:30 Eastern Time. In about an hour from now, we'll catch up with Ray Dalio of Bridgewater. Great lineup with Tom Keene out in Greenwich, Connecticut. Here in New York City this morning. Good morning. This is Bloomberg.
If you look at China, if you look at U.S. taxes, how much time do you spend figuring out these big overarching themes as opposed to what happens with inflation?
There's an awful lot going on at the moment, as you say, and clearly some of the big debates at the moment are the slowing global growth picture, which we're seeing everywhere. And we're also seeing that at a time when inflation is rising and is proving pretty sticky. And to your earlier points, Francine, essentially the interplay between those two is critical. So some of those news events this week, whether it's OPEC and what's happening from a supply perspective, is going to be crucial, or indeed, of course, that US CPI print. So we've spent a lot of time thinking about inflation more recently, because clearly that leads into when we feel you may start to see the taper and when you might start to see rates going back up, particularly in the US. I mean, what might be useful just to explain a little bit is the focus that we've seen from everybody on China. You know, clearly China, huge in terms of the global commodity cycle.
I think what we've seen during this period of time is that communicating via video is not a fad, that we are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
deep breath. It's only Tuesday from New York City for our audience worldwide. Good morning to you on radio, on TV. Here's the price action this Tuesday morning. We are positive by 0.75% on the S&P. We're up about 33 points. The story in the NASDAQ up about 0.7%. On the Russell, the small caps advancing a little bit more than 1%. The focus still on Evergrande. Switch up the board and get to the China dashboard. We'll take a little look at that together. Evergrande, the focus here, and the conversation at the moment goes a little something like this. Is it Lehman? No, move on. Look, I think we've got to be far more nuanced than that. Are we going to see the contagion through the financial channel? We can have a debate. Let's have a nuanced conversation about it. Will we see the contagion through the real economy? Let's have a nuanced debate about that. Bank of America are already downgrading their outlook. I'm sure others will follow. They come in from 6.2% for next year down to 5.3%. And if you're going to plug that into the market, I would look at two places. I'd see it in the Aussie, I'd see it in copper. This morning, copper positive by 0.75%. The Aussie stronger. Aussie dollar out to 72.63, up a little more than 0.1%. But that's the focus for me here. It's not just about financial, systemic risk contagion and all of that, Tom. We've got to talk about the real economy. And for the real economy, it's pretty clear to me what the channel is.
John, to me, what's so important here is when do we see government response? It's Tuesday evening, night in Beijing. They're trying to get to Friday and the weekend where they can control the messaging. Can they do that? Do they have that amount of time?
Well, the market's been closed there till Monday, Tuesday, on to Thursday. Reopens tomorrow, I think. Then we go on to Thursday, and we've got that interest due on those bonds. That's going to be interesting to see what the communication looks like this coming Thursday, the day after that Fed decision. This is the setup in the bond market going into that Fed decision. Switch up the board and get to bonds. 2s, 10s, and 30s. 10-year yields were lower yesterday. They're higher this morning by about a basis point, but no drama here. Getting back to 132.43. Curve steeper. 30s up 2 basis points, back to 186.72. Just an idea of where things stand going into that Fed call tomorrow. The 2-day meeting begins today, and we have hardly discussed it. Our eyes are looking somewhere else. That's the story. Cross asset yields on 10s, 132.43. Let's get you some movers. Here's Romain Bostic.
Yeah, good morning, John. Of course, yesterday's individual movers were all about that macro story, that top-down story. Today, it's more of a bottom-up type of day. Uber, of course, the unprofitable rideshare company, says, well, that may no longer be its moniker, saying that it could reach profitability by the current quarter, the third quarter. It previously said it could do that by the end of the year in the fourth quarter. It's giving a pretty wide, though, swath here for profitability, saying that its adjusted EBITDA for the current quarter could be a loss of $25 million or profitability of $25 million, give or take here. So we'll see how investors react to this. The shares are up about 5% pre-market. Remember, Lyft actually posted a surprise second quarter profit in its most recent reporting period. J&J shares up fractionally here on the day. Of course, releasing some of that phase 3 data on the efficacy of its booster shots. And Lennar shares down about 2% here. The company actually provided third quarter deliveries that came in less than what the street was looking for, and it provided a fourth quarter guidance that was also a little bit weak here. I guess the one silver lining here, this is much more of a supply issue, basically the company's inability to get all the parts it needs to finish those homes, but the demand pipeline still seems to be pretty robust, so maybe this worked itself out in the end. Flip up the board. Late yesterday, we did get news out of ConocoPhillips, basically the U.S. Oil company agreeing to buy the U.S.-based Permian assets from Royal Dutch Shell. It's a $9.5 billion deal. This is a huge deal for ConocoPhillips and for Shell. Most of that money, that $9.5 billion, about $7 billion, going right back to investors through a special dividend. American Airlines here up for a second straight day. Remember, this was the one big bright spot yesterday here in the sell-off. A lot of the airlines rallying on the U.S. and releasing some of those travel restrictions on foreign travelers. And Lucid Motors now up for a 5th straight day here based on the pre-market pricing, up 2% here. This is on the back of that news last week, of course, of getting certification of the longest range EV vehicle to come to market. Tom?
Remain valuable. I missed the ConocoPhillips story. It's great to hear that this morning. At the Greenwich Economic Forum, they're in recovery after a difficult pandemic year. Over 200 true industry leaders will be here today. And the basic theme is, what do we do with the zero bound? And how does it redound back to central banks worldwide, and particularly to Jerome Powell tomorrow in Washington? We start now with Mickey Levy of Berenberg, of course, acclaimed as someone who has always watched inflation dynamics. We're thrilled that Dr. Levy could start us strong this morning. Coming up, Noel Rabini and Ray Dalio. Dr. Levy, I want to talk about the transmission where we have no inflation or less inflation or sort of inflation over to one big Steve Roach asset bubble? Do you buy the idea that all the manipulation of the last 12 and 13 years has done nothing but move inflation over to the true proxy, which is an asset bubble?
Well, look, not really. I mean, let's think this through. Financial crisis, post-financial crisis, QE 1, 2, 3, they did not generate stronger economic activity. They did bloat asset prices, and so that you didn't get the higher inflation because you didn't have excess demand. Fast forward to where we are today, and it's just absolutely clear that this unprecedented monetary and fiscal stimulus has generated a big boost in aggregate demand. At the same time, you have supply shortages, so you end out with inflation. And you know, the Fed has redefined the term temporary. This has lasted much longer than anybody had thought. So here we get a combination of, you know, asset prices have increased because of the strong economy and you know, strong rebound in profits, and bond yields staying low. You know, the big issue going forward is, you know, this inflation is going to persist for a while, and you know, eventually the Fed's going to have to normalize, and then it'll be very interesting to see, as the Fed tapers, and then eventually as it normalizes interest rates, how will bond markets and the stock market respond?
Mickey, can I pick up on that word normalize? What does that mean anymore, to normalize? What does that mean?
Well, Jonathan, that's a great question, because when we think about monetary policy, the Federal Reserve, its estimate of a normal federal funds rate is about 0.5% real, and then the 2% inflation, so 2.5. And so right now, the Fed has increased its balance sheet to about $8.5 trillion. But more importantly, it's kept interest rates at zero. So the Fed's going to eventually, you know, after it tapers, it's going to have to allow or start to not allow, but raise bond yields, normalize them to that rate, which is consistent with its long-run objectives. That is stable, low inflation and sustained economic growth. And that's the real dilemma the Fed faces.
Mickey, when the Fed tapers, what difference does it make when $120 billion a month becomes 100 or 80 or 40? What tangible changes?
Doesn't have any impact at all. I mean, that's just a great question. So think about the following. You have an $8.5 trillion portfolio at the Fed. It's buying $120 billion extra a month, and it's reinvesting all of the maturing assets. What's the difference to the economy or financial markets, whether if it slows down and buys 105 billion new a month rather than 120? It has no impact on the economy. And in fact, it's really quite striking that the Fed Chair Powell has said several times, when we begin tapering, it has no implications at all for when we hike rates. And so the market is focusing on this tapering, which doesn't have really any impact at all. You could have an announcement effect. Bond yields will go up a little bit, but they're already ridiculously low. So it really shouldn't have much of an impact at all.
Mickey, appreciate the conversation. As always, Mickey Levy there, Berenberg Capital Markets Chief Economist, going into that Fed decision tomorrow. TK, you know what the worry is. The worry is that the Fed misses the window to do anything and gets stuck here in the same way Japan did and the same way Europe has.
Yes.
And that the Fed joins the party. Now, I don't have a view on that, Tom, but that debate has picked up a lot in the last 6 months.
Well, that's so true, and it's something Nora Robini is expert at. The mistake that the Bank of Japan made years and years ago, they lifted rates, they were wrong. To save face, they had to lower rates. It was ugly. There's been some other instances in central bank history. But it all comes down, John, to we are visiting Greenwich and the Greenwich Economic Forum at the zero bound. You can define that any way you want, but that's going to be my focus with Robini, my focus with Dalio. Governor Lamont doesn't want to talk about the zero bound, but he does want to talk about the fiscal shocks that it brings on.
I'm sure he'd like the borrowing costs, Tom, the equivalent over in Connecticut. Can we talk a little bit about that? what these governors are going to do to get people to come back to their states.
Well, if you're going to raise taxes, and it is my first question, John, you saw the preparatory questions that I had for the governor. It's got to be the first question. Is President Biden going to force another exodus to Florida and such ideas?
Out of Connecticut and out of New York as well. Just on the zero bound for Ray Dalio and Bridgewater, Tom, what's the focus there at 8:30? What are you looking to get out of Ray?
They're different. With Nora Rubini, the zero bound is about the interdependencies of global economies. With Ray Dalio, it is about the tangible performance of what he has done, is arguably the most prestigious hedge fund manager in the world, an acclaimed author. In Bridgewater has had a really, really, really tough go of it. John, you nailed this with Bob Prince and Davos. They've got to recalibrate their core theories given the duration that we're at the zero bound, and it's been an immense challenge through the pandemic.
Tom, I think we're all looking forward to it. Looking forward to hearing what Mr. Dalio's got to say at 8:30 Eastern Time. Before we get there, we can hear from Afsan Ebeshlos, the Rock Creek CEO, will be joining us next. We've got to do a couple of things this morning. Tom's going to run you through some important conversations in Greenwich, Connecticut. Katie and I are going to stay on top of what's happening in this market. Equities are bouncing back, but the bounce back's fading just a little bit. Up now just 0.7%, positive 0.67% on the S&P. We're positive 29 points. In the bond market, yields are higher, but only by a basis point now to 132.09. Counting you down to that Fed decision. Special coverage coming live on Bloomberg TV and radio tomorrow afternoon. From New York City this morning, good morning. This is Bloomberg.
With the first word news, I'm Ritika Gupta in Canada. Prime Minister Justin Trudeau faces the prospect of another fragmented parliament. Trudeau won a third term in the snap election, but his Liberal Party fell short of the majority he was seeking. That means he'll have to rely on smaller parties to pursue his left-leaning agenda. For a second straight election, Liberals lost the popular vote to the Conservatives. House Democrats are taking a risky move that assures a potentially damaging showdown with Republicans. They will include a suspension of the debt ceiling in a spending bill needed to keep the government open past the end of the month. Republicans have already said they won't vote to raise the debt limit. All this could be leading towards a government shutdown at the end of the month. Shareholders in Royal Dutch Shell are getting an unexpected $7 billion payout. The company promised to give them 3/4 of the proceeds from the sale of the Permian Shell oil fields to ConocoPhillips. The cash pledge comes less than 2 months after Shell raised its dividend by almost 40% and started $2 billion of share buybacks. FedEx plans to raise its delivery rates next year by the most in at least a decade. The average cost of package delivery will increase 5.9% at both the express and ground units. Some freight rates will increase by almost 8%. Transportation costs have been rising because of strong demand combined with higher wages for drivers and warehouse workers. And shares of Universal Music Group soared by as much as 43% in their stock market debut today. UMG was spun off from French media group Vivendi. The stock began trading days after the U.S. recorded music sector reported strong sales growth driven by a surge in streaming audiences. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
ask about your experience as a young woman and as a woman working in this sector, and of course having that amount of scrutiny and public attention on you. South Korea doesn't have a very good record when it comes to gender relations, the wage gap, treatment of women. Did you have a personal experience of that deficit?
I was in a mechanical engineering department for 10 years for my undergrad and PhD. Of course, I was just 2 girls among the 120 classmates in the mechanical engineering department. And then at the time, our workshop building, we even didn't have a female bathroom. So when I watched the Hidden Figures, that was so sympathizing with my experience, because I should go all the way to the campus to go to the female bathroom out of the building. But I really want to see the tendency of the development rather than the current status.
From New York City.
We're in London, in Sydney,
In San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
This is Bloomberg Daybreak with Lee.
Balance of Power on Bloomberg Radio.
Welcome to Daybreak Australia.
This is Bloomberg Technology.
And this is Bloomberg Green.
To recap the headlines.
You do not want to miss this story.
Really good news on the jobless claims
How
front.
are you thinking about those dynamics?
The EU's longest-serving leader is leaving. Who will run Germany next? Join Francine Lacroix for the first results and analysis on Bloomberg Germany Decides. Tune in for live coverage beginning at 5 p.m. Sunday on Bloomberg Television and Radio.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Global markets never sleep, so stay connected with Francine Lacroix in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, Early Edition. Weekday mornings on Bloomberg Television.
We haven't joined the consensus yet. We've remained one of 6 countries. We've been broadly supportive of the process, but we haven't signed up to the consensus yet because of some aspects of it which we believe do not give certainty or continuity.
The Prime Minister of Ireland from New York City this morning. Good morning. Alongside Tom Keane and Katie Lyons, I'm Jonathan Ferro. Lisa Abrambis will be back with us on Thursday. Skipping a Fed decision, going into that Fed call tomorrow. 2-day meeting begins today. This is your equity market up 32, advancing 0.75%. Yields just a little bit higher by a basis point to 132.26. TK, it's not much of a relief bounce, is it, in the equity market compared to what we saw yesterday, or in the bond market for that matter as well?
Well, I take the point that it started at 2 p.m. yesterday, but John, at 2 p.m. yesterday and following through, is this one massive buy the dip?
I've got no idea, Tom, what to call this. We've got to work through so much. When I spoke to Mike Wilson at Morgan Stanley yesterday, he said price, he thinks 10 to 20% lower. Time, he thinks it's going to take 2 to 3 months to work some of these issues out, Tom.
No one heard that from UBS and Joe Draho today, the bumpy ride for the next few months. Right now, and this is a great joy, she gave us so much perspective on Afghanistan and looking west to her Iran. Afshani Beshelos joins us right now from Rock Creek. She will have an important conversation to a sprightly Alan Greenspan tomorrow here at the Greenwich Economic Forum. That will be a timely conversation. Dr. Beshelos, thank you so much for joining us. There's a nostalgia right now of moving from the chaos of the Powell Fed, making it up as we go, back to the cadence of the Fed of Arthur Burns, of Alan Greenspan. Can we go back? And if not, how do we move forward out of this crisis?
I think, Tom, what has been really interesting is I don't think it has been so chaotic, in fact. The Fed has been giving us a pretty good indication of where it has been and where it's going. Obviously, the times have been, the kind of the pandemic, which killed more than it killed even in 1918, was something that no Federal Reserve with Alan Greenspan or Arthur Burns or Jay Powell could threat to very easily. But no question, I think the meeting this week, today, tomorrow, is going to be very critical. And people will be listening very very carefully, like the way they used to listen to the way Alan talked, not just what he said. but
Yes.
how loud his voice was?
No, I think you're absolutely right. I want to speak to you about the famed Greenspan granularity, the way the gentleman from NYU would look at each and every rail car, each and every data. That granularity works in goods-producing economies. Do you have a confidence that we can shift to a service sector prosperity and do that with this technology overlay we're all talking about?
So the interesting thing in talking to Alan is that he does these daily forecasts. Remember, he was a forecaster before he was a Fed chair. And he has continued doing that, interestingly, with the huge problems we have with the supply chain right now. The kind of work he was doing on railways and counting the rails, trucks and cars, and looking at the sort of the minutia on the supply side has become incredibly, incredibly valuable. But because the tech sector, as you said, may not get well measured in some of his estimates, but supply chain problems that we're facing is very traditional economics 101.
Obviously, a lot of those supply chain issues have led to higher inflation, and we actually had the OECD releasing its interim forecast earlier today, expecting higher inflation in the U.S. and the U.K. and in the Eurozone, but also saying that supportive fiscal and monetary policy needs to stay in place. Is that going to mean inflation runs too hot for too long?
I actually believe in the Draw Creek, we are looking at inflation being more of a short to medium term issue. There's no question that if you throw in so much liquidity that will now start slowly being taken out of the economy, if you have the kind of disruptions we have, even as we're speaking, there are ports that are getting closed down because of sick people with COVID. So that, while that is going on, there's no question we're going to have disruptions, and that will be pushing up inflation. I think as we get into 2022, 2023, if the assumption is, COVID is endemic and it sort of stays on in a smaller way, that will be a different scenario, obviously. If that continues, I think that's a whole other issue, bigger problems than inflation.
Well, you mentioned port closures there. Obviously, we had one in China for quite some time at one of the world's biggest ports. And also going on in China, you had broader restrictions due to the Delta variant. You have a crackdown on steel production because of a decarbonization effort. And you have the situation with the property sector being trying to be reined in by regulators. And obviously, Evergrande is front and center. How worried about China are you when you think about a global economy right now?
So Evergrande obviously is a big topic today, but it has been really, the problems with Evergrande have been known in the marketplace for some time. The bigger topic, I think, in China is that we're so used for growth rates in China having been 8 to 10%, that people don't realize that kind of growth rate is not going to stay forever. So if you assume a more normalized growth rate in China, which moves down to closer to 4, 5, 6%, regardless, that's a very big range I'm giving you, I think we will be in a very different situation in China. Obviously, they have major problems with an aging population, and those are sort of the aging population and the fact that you will have a slower growth rate, I think, are the bigger issues that are getting forgotten as we get concentrated on Evergrande. And on Evergrande, I think the government will not bail out, most likely, but they will manage it in the way, and they will sort of let it go out and down slowly in a managed way, probably.
There's a lot of faith they'll be able to do that. Afsane, we've got to leave it there. It's a really important final point as well. Afsane Beschloss there, the Rock Creek CEO. Tom, you've made this point many, many times over the last few years. Get ready to get used to 5% GDP growth out of China.
Well, you get 5% GDP growth and it falls into this commodity rally and can sustains. Dr. Beschloss is truly the nation's expert on natural gas dynamics at the international level. I mean, John, talking to her about her trip to the Khyber Pass in our last visit was extraordinary. And you really wonder, away from oil, what the other hydrocarbons do, what the metals do over the next year.
Tom, look, let's talk about it. How do you have a demand-driven super cycle if China's not at the epicenter of it? What does that look like?
You don't.
You don't.
The experts will tell you you don't. I must admit, when you see Francisco Blanch at $100 in oil and the knock-on of that to the rest of the economy, Well, you wonder maybe they're more optimistic than the media is.
I'd love to hear from Francisco Blanche this morning and fold in the China story to all of this. Jeff Curry at Goldman as well, Tom. Crude this morning, Brent up 0.7 to 74.58. WTI $71, up around about 1 percentage point. Stage set as follows, going into the opening bell a couple of hours away. The equity market stateside, equity futures up 32 on the S&P. We advanced by 0.7%. Yes, TK.
John, it's unbelievable. 3 herons fly in from the harbor going north, and in walks Noel Rubini. There's been a Rubini sighting.
Have you seen him? He's just not sitting with you yet. Would you like to stay there?
No, Harry left.
I can arrange
Harry
this.
left.
Would you like to stay
lonely.
there?
I'm sorry, I'm lonely.
I can tell. This is Bloomberg.
Electricity subscriptions, it's a part of this new business area that we have called the clean energy services. So the purpose for this new business area is to contribute and to create this biggest movement in the world for renewable energy. We will add even more products. We have solar panels that we sell, and now we have the electricity subscription. So it really fits that ambition that we have to, within the frame of life at home, the most important place in the world, we can add more value to our customers to live more sustainably. And this is a big part of the climate positive strategy that IKEA has for 2030, that we will remove and reduce climate emissions more than we emit in our entire value chain.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
In crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
We're in Iraq
rocky period here. I wouldn't think this correction's quite over yet, frankly.
I never want to see a down market, but I do think that this is just a natural part of the process.
The risk that we're mostly unhedged for is this rise in inflation.
All of these economic interdependencies just look increasingly like weaknesses, and that's what we're seeing.
We have a lot of supply bottlenecks that is due to the fact that the world is not being vaccinated enough.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowitz.
This week is just getting started. From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio. Alongside Katie Lyons, I'm Jonathan Ferro here in New York City. Lisa Abramowitz back with us in a couple of days. Over in Greenwich, Connecticut, Tom Keene standing by with a fantastic lineup of guests through the next hour. TK futures up 32, advancing 0.75%.
We knew, John, a Greenwich Economic Forum would be important with the news events and particularly what we see in China. To speak to Noel Rubini in moments and Ray Dalio later, to speak to the governor of Connecticut about the new tax regime of the Biden administration. It's a timely visit. And, John, I might point out, a perfect day.
Tom Keene, let's not waste any time. I'll get straight to the price action. Cross-asset worldwide. Equity futures shaping up as follows on the S&P. Up 32, advancing 0.75%. Yesterday, the biggest one-day slide going all the way back to May. Yields higher by a basis point to 132.43. Crude positive by 1 percentage point to $71. Katie Lyons, Bank of America, those calls, those forecasts for Chinese growth, that caught my eye. I know it caught yours.
Yeah, not just for this year, John, out to 2022 and then cutting it even for 2023. And there's a multitude of factors here. It isn't just what's going on in the property sector, the questions around a potential default of Evergrande. It is also the decarbonization effort in the country, the fact that commodity production is going to be lower, as well as the Delta variant, how strict China has been with some of their restrictions when you see a resurgence in cases. That sets China apart from what we're seeing in a lot of other developed countries, and all of that factoring in to that forecast from Bank of America, John.
Tom, it's about China, 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 and you've got the perfect guest to set up that conversation.
We start strong in this hour with Mr. Dalio with us later, with Noel Rubini. Crisis economics of 11 years ago, but far more the Noel Rubini who got way out front of that crisis of 05, seeing things come along in 07, 08, 09. And I want to give you a little window right now before we get to the present moment of what Noel and I have lived. There was you and I in Davos at a hotel. It was a late night, and we sat there and we penciled out the reversion of the mean of the housing market. And you said it's got to end, and it did a year later, maybe 18 months later. Bring us forward now that we are so debt encumbered. Do we have the degrees of freedom that we had when you and I sat at that quiet bar in Davos?
Well, my concern is that compared to a decade ago, debt levels, both private and public, are much higher than before. 20 years ago, debt to GDP ratio globally was about 200% of GDP. Right now it's 360 and rising. In advanced economies, it's 420% of GDP and rising. In China, it's 330% of GDP and rising. So my concern is that we are in a debt trap. It's not just fiscal dominance, but when central banks are going to want to essentially phase out unconventional monetary policy, given the debt ratios, there is a risk of a crash in the bond market, in the credit market, the stock market, and the economy, and therefore they'll be in a debt trap and unable to normalize policy rates. That's why I see inflation ahead.
Dr. Rubini, I am so honored that you're here. I am pleased to announce, folks, that Barry Eichengreen's new book on debt is my book of the year, and this is the guy to talk to about it. Eichengreen spans from golden fetters over to this new debt crisis now. How do you interpret the outcome of this buildup in debt, which is life at the zero bound?
Well, we're in a situation in which in normal times we're not reducing debts and deficits, while whenever there is a crisis, then we have to backstop the financial system. There is more buildup of public debt. There is more buildup of private debt because with zero policy rates or negative policy rates or quantitative easing credit is cheap. So we are in a debt super cycle where both in good times and in bad times debt ratios are rising, and therefore eventually central banks are in a trap. People said they're going to normalize policy rates, but with these levels of private and public debt, if they were trying to do that, there'll be a market crash, an economic crash, and therefore I think the path of least resistance, given that debt ratio, is going to be to wipe out the real value of nominal debt at fixed interest rates with higher inflation. That's one of the reasons why I see loose monetary policy, loose fiscal policy, loose credit policy, and eventually inflation being the source of the wiping out of the real debt.
This is the critical story. I went through the new European Paintings Gallery at the Met this week, and Nouriel speaks of the old world that you symbolize. Are we going to do the same thing they did in Venice in the city-state of the 15th century, which is inflate our way out of our present challenges?
Well, we have a huge amount of debt and deficit. What are the options? Are we going to cut government spending? Politically, the pressure everywhere in the world is to do more spending to essentially deal with income and wealth inequality. Are we going to raise taxes on the wealthy and the rich? There's going to be constraints on that. So there'll be constraints that are going to imply the deficit remain high, and therefore the path of least resistance is going to be to monetize them and try to wipe out with higher inflation the real value of nominal fixed interest rate debt. Of course, over time, debt is going to reprice. Short-term debt is going to be higher interest rates. With high and volatile inflation, risk premium are going to go higher. So that's going to be a solution in the short term, and eventually high debt ratios with real rates rising over time is going to imply debt defaults, because there'll be unsustainable debt situation, both in the private sector and in the public sector in a number of countries. So I see both inflation and debt crisis ahead. Yes.
John here. Good to catch up with you again, buddy.
Yes, John.
Great to have you on with us on the show. Walk me through what that means for trend growth through the next couple of years then, through the next 10 years for that matter, given everything you've just described.
Well, we have on one side debt ratios that are unsustainable, and as I pointed out, the current mild stagflation, where growth is lower and inflation is higher, is not just driven by short-term supply bottlenecks, both in goods market and the labor market. I pointed out that I see over the medium term 9 negative supply shocks that are going to reduce potential growth and increase cost of production over time. Very briefly, what's going to happen is deglobalization and protectionism. We'll have balkanization of global supply chains, aging of population in advanced economy and emerging markets, restrictions to migration from south to north, decoupling between US and China on trade, technology, data, information. We'll have global climate change going to increase the cost of energy and the cost of food prices. We have pandemics going to disrupt again global supply chains. We have also cyber warfare that's going to be a source of disruption of production. And finally, the rise in income and wealth inequality implies that there'll be monetary and fiscal policy trying to help workers, labor, unions, and that's going to put upward pressure on wages. So I see a situation which over the medium term, with loose monetary and fiscal and credit policy and these negative supply shocks, you could end up over the medium term in a situation of stagflation like in the 1970s. That's the situation I worry about.
And Nouriel, this is far more nuanced than I think many people realize. A lot of people are making this call for higher inflation based on loose fiscal policy, monetary policy staying easy. You're focused almost overwhelmingly on these structural issues that you think are just going to stick beyond the fiscal push that we've seen over the last year fading. How underappreciated is that view when you go to events like this and have that conversation on the sidelines of economic forums like the one you're at?
Well, I think it's unappreciated because even those who worry about rising inflation make an argument that once these short-term bottlenecks are going to go away, the source of inflation is going to be essentially overheating of the economy coming from the fact that monetary, fiscal, and credit policy is still too loose. I agree on that side that aggregate demand is going to be in overheating, but also worry about the medium-term aggregate supply of the economy. And I see these global trends that are just the reversal of the forces that for the last 30 years kept inflation low. All of them are reversing in a direction where potential growth is going to be lower, cost of production is going to be higher, and since monetary and fiscal policy and credit policy are going to be loose, eventually we end up with inflation and slower growth, thus stagflation.
Dr. Roubani, a final question. I want you to address for our audience on radio and TV the optimism you have of the American economic experiment. I have fought for a decade plus of calling you Dr. Doom. I don't buy it for a minute. You've got a lot of worries out there. But state the optimism you have on the American experiment.
Well, on the American experiment, I would say the most positive thing about it is that there is going to be a huge amount of technological innovation, whether it's AI, machine learning, robotic, automation, all the essentially application coming of it, gonna over time increase productivity growth significantly. However, I worry that AI, automation, robotic is gonna also have negative spillover. It's gonna increase income and wealth inequality. It's gonna lead to massive technological unemployment.
Is that a central bank responsibility? Can the central bank, as the social guide of last resort, do social policy within the central bank history?
Well, I worry that the central banks now are on a mission creep. They start by worrying about inflation, then growth, then financial stability, then income inequality, then global climate change, and a list of other factors. And that mission creep implies that they're becoming highly unconventional, and that's going to lead us to higher inflation over time. You have to limit what you have to do, and what you can do is only growth, inflation, and maybe financial stability. So that mission creep is part of what's going to lead to higher inflation by unconventional monetary policy being around for much longer than otherwise.
Nouriel, thank you, sir. As always, good to catch up. I thought Nouriel liked Dr. Doom. Tom, I know Nouriel likes that one. He's smiling, TK.
I don't like it.
Why don't you like it?
I got too much of a respect. He has old world.
Dr. Realist.
Yeah, Dr. Realist.
Dr. Realist.
Here's the
Neither
difference.
doom
This
nor
is John.
Optimist.
John, this is really important. He represents an old world economics that's worried about the solidity of balance sheets and financial statements versus an American modern income statement dynamics. That's the difference. He's not Dr. Doom. He's Dr. Istanbul.
He's been a good friend of this program over the years, and we appreciate it. Nouriel Roubini there, the CEO of Roubini Macro Associates and co-CEO of theboombust.com. In a bond market, yields are higher by a basis point. Equity futures up by 0.75%. This Tuesday morning is just getting started. Next up on the program, Governor Ned Lamont, the Democrat from Connecticut. Then on to Ray Dalio of Bridgewater, 8:30 Eastern Time. Tom Keene sitting down with him in Greenwich, Connecticut. So much still to come through the week. Then we've got a Fed decision on Wednesday, tomorrow. Futures up 33, up 0.75%. This is Bloomberg.
With the First Word News, I'm Ritika Gupta. New data suggests that a booster dose of Johnson & Johnson's coronavirus vaccine increases the potency of the one-time shot. The booster was 100% effective against severe disease when given 2 months after the first inoculation. A second study found that the additional J&J shot led to a 12-fold increase in the production of antibodies when it was given 6 months after the first one. In Canada, Prime Minister Justin Trudeau won a third term in a snap election, but he fell short of regaining the majority he was seeking. That means Trudeau's Liberal Party will have to rely on smaller parties in order to get legislation passed in Parliament. The Conservative Party actually won more of the popular vote than the Liberals. British Prime Minister Boris Johnson says President Biden has too many domestic priorities to find time to negotiate a trade deal with the UK. The two leaders meet today in Washington. A trade agreement with the US was billed as one of the prizes of Brexit. Johnson says he would rather have a good deal than a quick one. And Uber posted a quarterly loss of $5.2 billion now. The ride-hailing giant may be about to report its first profit in a filing today. Uber said adjusted earnings may range from $25 million loss to a $25 million profit in the third quarter. The company said that adjusted earnings in the fourth quarter could range from flat to $100 million profit. Global News 24 hours a day on air and on Bloomberg Quick Take. I'm Ritika Gupta. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
There is wide disagreement on whether we've seen the worst of the Delta variant in terms of the upsurge in cases. Where do you fall on that?
So I see that the curve is continuing to go up, which is worrying. What's making me really nervous today is that there is this accompanying surge in deaths as well.
Trading revenues coming in better than expected. Everything cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Another huge source of uncertainty is obviously inflation expectation, and we need both central banker and fiscal policymaker to give clear trajectory on their tools on the budget and monetary policy to make sure that those inflation expectations we were discussing actually remain anchored.
Let's get to work. Lawrence Boone there, the OECD chief economist from New York City this morning. Good morning. Alongside Tom Keene and Katie Lyons, I'm Jonathan Ferro. Equity futures up 30, let's call it 29, advancing 0.7%. In the bond market, yields higher by a basis point to 132.26. It was the headline we've been waiting for and largely expecting. Evergrande did miss those payments due Monday to at least 2 banks. The next stop for this story is Thursday, when some interest comes due on some bonds, Kaylee. We had a pretty strong steer from authorities that this payment yesterday would be missed. It's on to Thursday and really through the end of the week. Where's the solution? What's the plan?
Yeah, China had already told these banks to not expect to get paid by Evergrande yesterday. It's unclear yet whether the banks will declare Evergrande in default, but Thursday is really going to be key. And if we get any action from Beijing in between now and then, John, do they take steps to directly intervene? S&P Global Ratings, which overnight warned that this default was likely coming, also said they don't expect China to directly step in to help Evergrande. So it will be very interesting to see what we see from the policy response over the next 48 hours, John.
Tom, I know you've got an important conversation over in Greenwich, Connecticut. Just wanted to bring you that headline, TK. Evergrande missing, payments due Monday to at least
really
2
important.
banks. Widely expected. There it is.
Yeah, I look for a government response. I'm not sure they can get to Friday as well. It is a Greenwich Economic Forum, and it is about, well, your image of Connecticut, of the boats that stand around me here. My Grand Bank's 54 over there moored looks little small in Greenwich Harbor. But it is a Connecticut that mirrors this nation. The income disparities in this state are absolutely extraordinary. Ned Lamont, as governor, is steering this state forward. We have a conversation now on the inequalities of this state. You had the courage, as a fancy guy growing up with a Lamont family, you went down to Bridgeport and taught. What were the lessons you learned in Bridgeport, away from entrepreneurship, about the economic disparities of your state?
Yeah, good morning, Tom. Welcome to Connecticut. I taught up at Harding High School. That was probably 20 years ago. I taught a class on entrepreneurship, how to start up a business. Here's what I learned. I said, find an entrepreneur and write a story about somebody you know who started up a business and they didn't know. They didn't have role models there. So I brought in entrepreneurs who had created businesses, trying to inspire these kids that you can do it too.
What do you need from the Biden administration? Taxes are front and center. We'll get to the SALT thing in a moment. But on a holistic basis of all the people of Connecticut, the north, up towards western Massachusetts and over to the east to Rhode Island, what do you need holistically from the Biden administration on a new tax policy?
I want to see this infrastructure bill pass. You know, I could take 10 minutes.
Does it all go into I-95?
Metro North, a lot of Metro North. I-95 helps too. I mean, we have a lot of people moving to the state. 50,000 folks have moved in the state in the last 8 months. And I want to do everything I can to speed up rail service from Stamford down to Grand Central. That infrastructure bill helps there a lot. On taxes, you got to pay your bills, so just do it cautiously.
You took the Metro North, I believe, or at least the symbolism of it, down to Mets Yankees with the new governor of New York. State to us nationwide and worldwide the emotion you felt on this important remembrance of 9/11.
20th anniversary of 9/11. I was in the city that day. Remember like yesterday? Remember going out in the street? The cell phones weren't working. You said, man, this is something the likes of which we'd never been through before. And there I was with Eric Adams and Kathy Hochul, the new leaders of New York.
Can Adams get it done?
He can get it done. I was very impressed with both of them. And look, Connecticut, we live and die by how successful New York is. We've got to work very collaboratively. It doesn't work for me to speed up Metro North to the Westchester border. Then it's up to them. We got to do it together.
Obviously, we've also never dealt with a situation like this when talking about the pandemic, Governor, and this is something that is front and center amid this current surge and as the school season is still underway with many students not able or eligible to be vaccinated. Why is it that those who are eligible don't need to be in the state of Connecticut?
Why is it that those who are not eligible? What I can tell you is our schools are open. Our schools were open last September. That made a big difference. New York City took a little bit longer. I think a lot of families started moving to Connecticut because they wanted their kids in school. We're able to do that safely. This year, our schools have been open. Very few quarantines, almost none, mainly because teachers are vaccinated and kids are wearing a mask. We're going to do that a little bit longer so our kids can stay in school and their parents can get back to work.
So that means the September 30th mask mandate is going to be extended for how long?
I think it's going to be extended a little bit longer. I got to work with my friends in the legislature on that. I see the virus coming up, obviously less in Florida and Georgia now, more in North and South Carolina, Tennessee. So as it heads up here during the flu season, I want to be careful.
Boy, is there a polarized tax out there, and it's a SALT tax. I hear you stop conversations when you talk about this tax. It's on property and my ability to deduct my Greenwich taxes, my Connecticut state taxes over a certain level. Ned Lamont on how we affect a real estate tax deduction fairly.
Well, obviously, when they unilaterally ended the SALT deduction, it hit states like ours a lot. And you can argue about the intellectual merits of the SALT deduction. I can just tell you that Connecticut is one of the few donor states. We send a lot more money to Washington than we get back.
This is critical. You send a lot more money to Mitch McConnell's Kentucky?
Absolutely. Oh, yeah. So I'm fighting for Connecticut. So that's why I think anything that reduces taxes for people in all income brackets here at the federal level makes sense. That includes getting back the SALT deduction.
Governor, thank you so much for joining us at the Greenwich Economic Forum. John Farrow?
TK, thank you. And thanks to the governor as well. Just want to wrap up those headlines that came out of Evergrande. The missed interest payments due Monday were missed to at least two of its largest bank creditors, widely expected. We have confirmation of that right now. Just want to go through some additional details from the team at Bloomberg that we've put together. Evergrande hadn't made the payments as of late Tuesday local time. This according to people familiar with the matter, asking not to be identified because we're discussing private information. Banks were expecting Evergrande to miss the deadline after the housing ministry told them the company would be unable to pay on time. We had that strong steer over the last couple of weeks. Now, Katie, the next stage of this conversation, and you touched on it, it's unclear whether the banks will formally declare Evergrande in default. This might take a few days, a few weeks, several months. I have no idea. We know there was a single-day grace period for these particular payments on these particular loans. And I understand that on Thursday, when the interest comes due on those bonds, I think for the covenants of one of the bonds, I think it's 30 days after that. So there's just some stuff to work through here, just the logistics, the nuance for a lot of this stuff.
Yeah, it's whether or not we get the formal declaration of default, or the formal one, excuse me, John, but the basic point here is that this is the world's most indebted property developer with hundreds of billions of dollars in liabilities, and it is in crisis. And to this point, we haven't seen much direct intervention from Beijing, from China, from the PBOC. And the question is if we're going to get it in the coming days, especially as that Thursday deadline is looming, John.
The next stop is Thursday. Interest due on 2 bonds. Full coverage, of course, right here on Bloomberg. Before we get to Thursday, we've got to deal with the rest of Tuesday and get into Wednesday and a Fed decision. Yields are higher by a basis point, 132. Equities are positive, 0.7 on the S&P. We're up by 29. From New York City, heard on radio, seen on TV, this is Bloomberg.
Boosters work, and they will definitely help. The boosters, both the Moderna and the Pfizer booster, take antibodies back up to at least where they were, and probably twice or 4 times where they were at the peak. It's definitely teaching your immune system to recognize Delta better. The antibodies that people are making after a booster, they are better antibodies. And they're also probably then better antibodies at recognizing other variants in the future. If you get infected once, your immune system says, all right, here's how much I want to set aside of memory, right, to not get that again. You get infected twice, your immune system says, well, that didn't work, right? It should probably up that zone. You get infected 3 times, your immune system is like, all right, this is a problem. It's really worth not getting sick anymore. And so the vaccines are essentially that, right? And if the immune memory was pretty good after the second one, what's probably going to happen after the third one is that it's going to be more stable. Even if the peak is the same, you're going to keep more of it for a longer period of time. It's a race, right? It's a race between the virus and your immune system.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Live from New York City this Tuesday morning. Good morning. Alongside Tom Keene and Katie Lyons, I'm Jonathan Ferro. Lisa Abraham is back with us on Thursday. Going into that Fed decision, here's the setup, the bounce back from yesterday. Evergrande still at the epicenter of the concerns here, up 26 on the S&P. We advanced 0.6%. We can confirm that Evergrande did miss those loan payments to banks. Another deadline comes on Thursday when some interest is due on a couple of bonds. We'll bring you coverage on that, no doubt. Yields high by a basis point on 10s this morning, 132. That is your yield on a 10-year Treasury. An important conversation taking place over in Greenwich, Connecticut. Tom Keene, we've been building up to this one all morning.
A really timely conversation, always with Ray Dalio, but with what's going on, and we'll finish strong with China here in a moment. This is really, really timely for Global Wall Street. We welcome all of you on Bloomberg Television and on Bloomberg Radio. John Farrell mentions Evergrande there. Is Bridgewater up to their eyeballs in Evergrande paper?
No, we don't have any.
You don't have any Evergrande? No. I got to make some news here. Help me out, Ray. Ray has the bravest bio I've ever seen. Let me go here, and I have a nodding familiarity with this. In his high school years, Dalio was a mediocre student. What happened? How did you go from a mediocre student to the success you've seen over so many years?
Then I liked markets. I was a kid. I mean, school, when they cram stuff down your throat, and it just didn't interest me. Markets interested me.
The markets interested you, and the mathematics of the markets and and girls. Okay, of course we knew that, but Long Island. But the dynamics of it, the dynamics of the markets. When did that click in for you? Did it wait for
when I was 12?
When you were 12?
Well, I caddied, and this was the '60s, and it was that was the hottest time in the markets. Like every time you'd get a haircut or shoe shine, somebody would talk to you about the markets. So I caddied, and I took my caddying money and I put it in the markets, and I didn't know what I was doing. The first stock I bought was my whole criteria was it was the only company that I ever heard of that was selling for less than $5 a share. Northeast Airlines.
Okay, they did well.
and like my investment criteria was I could buy more shares, so if it went up, I'd make more money. That was my criteria.
How did it work out?
Well, what happened is it has come to, and he was about to go bankrupt, and somebody acquired it, and it tripled, and I thought this game is easy.
So that was the start.
Right? But of course the game isn't easy.
The game has not been easy for Bridgewater. Let's get this out of the way. Our Catherine Burton has done wonderful reporting on the struggles of the entire industry. The difference is, in 07-08, you had challenging years, and you bounced back with a vengeance. Can you bounce back now with markets at the zero bound?
07-08 was a great year because we anticipated the financial crisis, and we did great. And then we had and so on. Recently, we missed the COVID coming, and then we got hit by the COVID coming. And so then we bounced back from that. But I think we didn't take as much risk as we could because we added value, but not as much as we should have added.
I want you to speak to Bridgewater clients now and those with billions lined up considering giving you money. What are the new procedures at Bridgewater to be more supple in the market, given where credit markets are again at the zero bound?
Well, I don't think there's new procedures. It is the amount of risk that one wants to take at certain times. So if you take our all-weather fund, for example, I think it's up 10 plus something this year. It could have been more aggressive. The question is, in this risky environment, how much do you want to be aggressive? We're always looking at things that we can do better. That pandemic is something that we've examined, and we learn a little bit more. But by and large, it's the same, just more of it.
Stephen Roach of Yale University, acclaimed at Morgan Stanley, says it's the single biggest miss he's ever missed was how we came out of the pandemic. How do you feel the nation and our fiscal status will come out of the huge debt buildup we have? How do you believe America will de-debt?
Well, this has all happened over and over again. that's what caught my attention. When you hit a zero interest rate and you have too much debt and everybody needs money, the way it works is the government sends out the checks, but the government can't print money. So it has to borrow money from the Federal Reserve and borrow money from others. And they don't have enough money, so that they print the money. And so the value of cash and the value of bonds has negative real returns, significantly negative real returns. And so money goes somewhere else. It goes into, traditionally, equities, it goes into gold, it goes into property, it goes,
The house over there, Ray, just went up $300,000 when you sat down in the chair. Continue.
But the same thing happened in 1971, August 1971. Same thing happened in March 1933. And that was when they produced a lot more money and that monetization, which moves its way through the system. Mechanistically, the way it works. A bond, the Federal Reserve comes in and buys a bond. It gives it to an investor. That investor then in turn puts it into other investments. And then it gives it to the public through the government. So this is, that's the way the mechanics is.
Ray Dalio with us at the Greenwich Economic Forum on Bloomberg Radio and Bloomberg Television this morning. Let's go to China now. It's so much in the news. I wanted to wait, but I think we've just got to get to China right now. This is a new Beijing. Is it a return to an old Beijing that you and I knew when you were buying Northeast Air? Or do you envision a Beijing that's moving to a new territory?
Well, you have daughter and son-in-law in Shanghai, and so we get
We're living in real time.
We're living in real time, and the more you have contact, I think the more you understand it. I don't think it's well understood. For a long time, the question is how can communism and capitalism coexist? That's the riddle you have to answer, and you had to answer it a while ago. And what do these people want at the top? And what the answer to that riddle was told also by Deng Xiaoping when he was asked. He said, it's glorious to be rich. And then they asked about capitalism, and he says, it doesn't matter if it's a black cat or a white cat, just as long as it catches mice. And so the idea is producing wealth. And so capitalism, yes, but the redistribution. Okay, so we have four things that are really going on in China, if you understand their intent. Common prosperity is the word now, okay? And it has been the objective to raise money and then to broaden the base of that, okay? That's common prosperity. So if you look at their tax rates, they're lower than the United States. If you look at the measures of almost capitalism, they have as much capitalism or more capitalism, much more so than Europe, for example. And now they're in a prospect to broaden that. So I think there's a tendency, and an understandable tendency, to think because they are Maoist and capital and communist that they're going to go back to that kind of a thing. And they're not. Deng Xiaoping, Xi Jinping, just, for example, introduced the newest stock market in Beijing. He made a point of being the one who introduced the market in Beijing to the small and medium-sized enterprises. They know that it catches mice. And so the issue is that the capitalist is not in control. The issue is that there's a system for the whole system, and then what they want to do is make sure that it's not a capitalist-driven system. So, and then there's data control, and then you have to understand there's micromanagement. It's like the kids, there's a top-down versus bottom-up. Whether you like it or not, it's what it is.
How can our listeners and our viewers prosper from their micromanagement of the real estate debt collapse we're beginning to see in China? What is the opportunity if we see their dominant investor position domestically go down in price? How do you play that?
Well, the mechanics are the same as the United States went through and everybody else went through. So it would be very similar to our 2008 mechanics.
Or recollapses or whatever.
So what we do, it's happened over and over again, is the central bank makes a decision of moral hazard. You know, they never used to have moral hazard.
Do you believe they're there right now after this week that we've seen in the markets?
Oh, they knew that this was happening, and there's a preparation for this, and they know that there's more, and that's a good thing, not a bad thing, because in the past it used to be that they would guarantee it. The banks, 5 major banks would loan state-owned enterprises and local governments with implied government guarantees, and it was bad. So the process is the same. Expect the exact same type of process as we would go through, which is to say that there will be stung. Investors will be stung. That's how it works. And that the system will be protected because it's denominated in their own currency.
Beautiful. I want to get this on the record, though, Ray Dalio, because every Wall Street firm is saying this morning this is not a Lehman moment. What we witnessed yesterday in the lesson in price. Explain why this is not a Lehman moment to Ray Dalio.
Well, because a Lehman moment produced pervasive structural damage through the system that wasn't rectified until the Treasury came across in terms of its borrowing, and then the Fed came across with quantitative easing. But this is not that kind of a shake-up type of thing. This is $300 billion is what they owe, and this is all manageable. The basic economics is for all countries in all time is that if your debt is in your own currency, you can deal with it.
You can work it out.
You could work it out. We've seen it happen over and over again. And it's a good thing that lenders get stung or that the borrowers get stung. That's how the system works.
Yeah, I want to go to my #1 question to Ray Dalio. I'm fascinated by this. You and I have sat at the M-Bar, at the Mandarin in Hong Kong, and looked at that spectacular experiment. I had the honor of Lord Patton with us the day of the Hong Kong collapse, the change essentially in polity there. How should our Western banks, the people you know, James Dimon, Staley of Barclays, Moynihan of a reinvigorated Bank of America, how should the Western banks adapt and adjust in Hong Kong to new China realities?
Well, I think very simply you have to decide whether the rules and the place is a place that you're comfortable with. They will set the rules, and you go in there and you decide if you're going to be part of that as a good citizen or you're not. And then, but you don't jump in and out. In other words, China's a strategic play. You're not going to jump in and out. And the amount that you're in should be that which you're comfortable with. It's the same as an investor. It's not smart to sell on the break or buy. It's a strategic play. Most investors are very overweight in the United States or other places. Diversification. There is a competition, a big competition, a war of sorts going on in technology and so on. The diversification, put the amount and the exposure that you want to have there, because you have to have places on some money on 2 chips, because there are risks in the United States too.
When we look at technology, and it's something you address courageously in Principles, the book did so well. When's the movie come out? 4th of July, what? 2024? Hanks is playing Dalio. Okay, so Principles was...
Well, I think like everybody, the key is know what you don't know, and how to deal with it.
What does he not know about the United States of America, the resiliency of this nation from the Pacific Rim, from Australia and MacArthur all the way up to Tokyo?
Well, there's a totally different approach. Whether you like it or not, we are a bottom-up individualist. It's built about individualists, and it's built, I think.
You're the example.
And the individuals, and bring immigrants to the United States, and that the power of the individual. In China, it is the top-down, and it is an extended family. One of the leaders said to me, for example, it's like a strict parent. And so when we deal with things like video games, do you want your kids to watch video games? In the United States, we would say that's a parental decision. Generally speaking, it wouldn't be the state to make that. They would say it's terrible what's going on, and the state is going to mandate it. So that there are those two approaches, and I would say that the understanding the relative merits and understanding really how we can get along. Because there's a risk of war. There's a risk of conflict here. And so understand how we can get along. I wish that, yes, Chinese understood Americans better and Americans understood Chinese better.
I want to bring it back to not so much to Bridgewater, but the alternative investment business, again, at the zero bound. You've written about this. You've been very eloquent. Bridgewater, folks, has a great series out on YouTube with Bob Prince, really walking through the realities of being at the lower bound. Is the game over? Is the volatility so taken out, almost like a somnolent Japanese bond market, that we can't provide value anymore above long-only institutional money?
Yeah, the value of interest rates, the impact of interest rates has been largely taken out in terms of the magnitudes. You're not going to have that kind of volatility. And if things go down, you're not going to have the same kind of protections from the bonds as you do. It's changed because then you get quantitative easing. It gets transmitted so that when you need an easing, you get the printing of money and then you have the reflation type of dynamic. So that's the way the volatility is transmitted. We've had plenty of volatility in the markets, but not in the bond market, right? Look at how the markets have behaved since in last April, they printed the money and sent out the checks. That's the way the dynamic works.
Well, what will the consultancy business be? I mean, we've all been wrong that the actuarial assumption is single digits, 6 or 7%, and everybody and people that caught the ride have been looking at double-digit actuarial returns. Are you and Bridgewater steeled for a single-digit future, or can you be more optimistic?
No, I think that I think we're going to get another round, another round of QE.
We're going to QE Dalio now?
What, sorry?
It's going to be called QE Dalio. You're predicting another round of QE.
Not immediately. I think that what happens is you get a taper. I think like every tightening of interest rates has been less than the one before it since 2000, since 1980. Every peak and every trough in interest rates has been lower than the one before it. And then when we hit zero, then we did QE, and every QE has been larger than the one before it, because we've accumulated so much debt and that we're now printing. I think that you'll have probably one pullback, and I'll call that a mock charge, and then you set the markets down, because the duration of the bond market and the duration of assets is longer. That means interest rate sensitivity is greater. You have that particular correction, and then you'll have another round of that. And so I think that's the nature of the beast that we're in with. The QE, understand, and that means negative real returns. The things that must happen is that cash is going to have a lower interest rate than bonds.
Is America going to go to negative interest rates?
Let me get my thought through, and then I'll come to that. Get your thought
through. Continue.
Okay. So, what you'll get is a significantly negative real cash rate, a negative and probably more significant real bond rate, and that you're going to continue to have interest rates significantly below nominal GDP growth. In other words, inflation plus real growth. The average thing is going to increase. Let's take nominal GDP, that's production of inflation and growth. You put those two things combined, you would rather own a piece of that, which is a piece of the economy, than you would want to own interest rates. That's the environment we're in, I believe.
We've got to wrap it up here in a bit. People are listening to this worldwide. My colleague Matthew Miller is in Berlin listening, and he's in my ear with Bloomberg Technology saying, can you just ask him about Bitcoin? Paulson of the hedge fund game, not Henry Paulson, the other Paulson, the great benefactor of Central Park. John Paulson is saying Bitcoin is a fraud, and I speak with my own words there. But what do you think about Bitcoin? Is it a durable thing for banks or for institutions?
I was going to ask on Bitcoin. I'm not an expert on Bitcoin, but I'll tell you what I think. I'll tell you what I think anyway. Anyways, take it. It's not worth much. But Bitcoin has an imputed value, not a intrinsic value, and so it depends what it's perceived as. It's a tremendous accomplishment to have done that programming, not have it hacked, and to have its advancement. At the same time, and so it will have the perceived value that it is given by the marketplace. Now, right now, if you take the value of Bitcoin, you take the price. What should the price be? And since the quantity doesn't change, you know what? It's a function of demand. Right now, Bitcoin is worth a little less than $1 trillion. Gold, all gold in existence, is worth, if you take central banks and jewelry out of it, about $5 trillion. So it's about 20% of that market that represents, the hedge market and so on. I think that if it's successful, really successful, it's not going to be a lot more than that. And if it's and also if it's successful, there's a risk the government will outlaw it. So that's what I think.
I got 20 seconds. I believe there's a new book coming out. Give us 20 seconds on your new book coming out.
Well, it's a study I did to understand what's going on now. I did the last 500 years to understand the rises and declines of reserve currencies and empires. And it's called The Changing World Order. And it describes the changing world order we're in, but putting it in a historical perspective.
Stick around. We'll go for another hour here. I'm kidding. Ray Dalio with us. Thank you so much with Bridgewater today. The huge impact of principles a few years ago and the changing world order. Look for that here in the coming weeks and months. Just so much to talk about here over the next number of hours with the Greenwich World Economic Forum. Kaylee, I believe the markets are open. Did Dalio move the markets?
Not quite open yet, Tom, but it's interesting. You are still seeing the dip behavior we saw at the end of yesterday's session when it comes to the S&P 500, but not with as much vigor as earlier on in the future session. Right now, S&P futures up about 0.7%, about 30 points. Interesting as well, the bond market has basically taken a round trip. Yields were higher earlier. Now they come in essentially flat on the 10-year yield, right at 130. And it is a weaker dollar story across the G10 space this morning, Tom. The euro stronger against the greenback by about 0.1%. We're out to 117.40 on the euro, Tom.
Thank you so much, Kaylee. Barry Ritholtz joins us for too brief a visit this morning. Barry, once again, buy the dip. Did we buy the dip yesterday at 2 p.m. and up we go?
I'm not so sure if we bought the dip, as this was just an overdue correction that's been out there. What is it, since last November was the last time we were down 5% on the S&P, and I think it was June since we've had a down 2% day. I don't even think we finished down 2% yesterday on the S&P. There is tons of capital sloshing around and no reason to think that this market is going to roll over anytime soon. Yesterday was a gut check day, down 2% and a handful of people panicked. That's just what markets do. They go up and down.
But Barry, to your point, we usually get a couple drawdowns of at least 5% every year. We haven't gotten one in 2021. Do you think there could be a catalyst to get one by the end of the year?
So you have to be careful about imposing a narrative on market action. It's always easy after the fact to come up with some sort of storyline as to why the market did what it did. But if we've learned anything over the past couple of decades, the day-to-day action is so noisy, it is effectively random. And so I try not to get too wrapped up in what happens yesterday. What's the catalyst that's going to drive this market down or up, for that matter? I don't know. My best guess is if Delta continues to run amok, if we continue to see 25 to 30% of the country refusing to act like adults and get vaccinated so we can get back to normal. If earnings, which have been spectacular this quarter, start to fall short due to supply constraints or just people cutting back on spending, those are the sort of things that could damage this uptrend, or something wholly unexpected. It's so hard to tell you what the next 3 months are going to look like.
Barry, what about the China risk? Ray Dalio adding his voice to the chorus of those saying this is not a Lehman moment. But do you think there could be more to come in terms of that playing out in global markets?
So here's the big question, and I'm very familiar with Ray's philosophy on this. I have a somewhat different view than he does. Where we agree is that China is a massive economic player, a powerhouse across so many ways. Where I think the U.S. perspective versus China varies is that we drank the Kool-Aid and we believe in capitalism and free market economics. To China, capitalism is just a useful tool. Hey, it was helpful to bring in Western companies to help build out their demand for their manufacturing and their software and their technology and all the different things that have made China one of the fastest growing, wealthiest nations on earth. Where we really don't see eye to eye on this is, I'm not sure if China wants to be investable to U.S. and other investors. That the bottom line is They don't respect private property. They don't believe in the sanctity of contract. And they certainly don't believe in a free market economy. So you could get these changes and bang, half of, there goes 50% of a sector's market cap.
Right. Barry, I want to come back to you in the coming days and really talk about the zero bound and what we talked to Mr. Dalio about, because I think folks have heated opinion about what that has rendered and how we get out of it in the coming years. And Barry has been out front with his podcast and writing in Bloomberg Opinion about it. Kaylee, the markets, off of 2 p.m. yesterday, it's been better than good. It's a nice pop.
Buy the dip, as always, Tom. We have seen this time and time again this year. Any kind of pullback in the equity market, be it 1% or 3%, it seems the next day they come in and they take advantage of those cheaper equity prices. My question, Tom, is with the Fed tomorrow coming up, which we all seem to have forgotten because of this Evergrande conversation, could that change and could that be yet another downside catalyst that this market has to consider?
It's been an extraordinary day. We needed to say thanks to Steve and all of our team up here with Micah. Just a terrific. They brought perfect weather to Greenwich, and we continue with that through this morning. From Toma Bravo, Orlando Bravo will join us as well. We're really looking forward to a discussion here on what he sees, particularly within private equity, and most of it off to the south as well. Really looking forward to that conversation. We thank the Greenwich Economic Forum. I hope to be here tomorrow, next week, into the autumn. Perfect. This is Bloomberg on radio, on television.
didn't want our story to be ended by Taliban. We wanted to continue the path that we started, to continue to go for our achievements and to go for having our dreams to reality. So that's why we decided to leave Afghanistan and go for somewhere safe. We are concerned that what will happen to our home then. Many people are leaving, but there are still girls who have dreams. There are still people who have dreams, and we want countries around the world to help Afghanistan to have peace over there, so that the girls over there can have the opportunities to continue their path as well.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
I support the new framework.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Every Friday with 30 minutes dedicated to fixed income. I'm Jonathan Ferro. This is Bloomberg Real Yield. It's a small bounce back on the S&P from New York City for our audience worldwide. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
From New York, we begin with a big issue, bracing for contagion.
People are concerned that the problems in China, well, they could actually continue elsewhere.
There's just a little bit more worry in markets.
This growing signs of contagion.
The idea that somehow this is going to be a worldwide contagion.
We're actually seeing more evidence of contagion.
I've been fairly concerned.
Definitely concerned about it in terms of the hit on sentiment.
It's not, not going to be isolated to just Evergrande.
This also feels like a little bit of a self-inflicted wound from China.
I'm more worried about the economics.
That's going to be really bad for the global growth story.
In these situations, you tend to see outflows, you tend to see the panic.
Investors are concerned with a sort of sell-first mentality.
For me, it's really a question of, does this signal continue?
We have to get to the Evergrande situation.
This story is not over yet. Joining me to discuss is State Street's Laurie Heinel and Chris Harvey of Wells Fargo. Laurie, let's begin with you. China, Evergrande, front and center still. What kind of contagion are you concerned about?
Well, at this juncture, we're less worried about contagion and more worried about the fact that this is just another one of those worries to add to the mix. We were already watching coronavirus and the Delta variant. There are concerns in the U.S. about a delayed, infrastructure bill, concerns about the debt ceiling, concerns about Fed tapering. So we don't think that the reaction of markets yesterday was just about Evergrande. It was part of this broader concern that it was time for a bit of a pause.
Chris Harvey, would you go with that? Is this just one more brick in a big wall of worry?
World of worry. There is contagion. As we think about it, there's two types of contagion. There's capital markets contagion and there's economic contagion. I think this is a capital markets kind. I don't think this filters over to the U.S. economy, but we will have to deal with this. I do think this is not over. We have the Fed tomorrow. We have debt ceiling issues, and we have a lot of issues surrounding earnings and so on and so forth. But at the end of the day, the underlying fundamentals are still good. I don't think this spills over to the U.S. economy, and we'll just have to deal with a capital market contagion for now.
The conversation I've heard in the past 24 hours goes a little something like this. Is it a Lehman moment? No, it's not a Lehman moment. Move on. I read this everywhere, through Wall Street. I see it around the world. This from UBS. I don't think this is a Lehman moment. Citi, we do not see the Evergrande crisis as China's Lehman moment. Barclays, is this China's Lehman moment? Not even close. Morgan Stanley, this is not a moment like we had in 2008. Laurie, is it a lot more nuanced than that? And I wonder why we always pick the most extreme benchmark to sit here and decide whether it's okay or not. Is that helpful to decide just whether it's a Lehman moment or not?
Well, people have been watching China's property market for years. And the good news here is that there already had been a fair amount of deleveraging in that market. We've gone from leverage ratios near 100% down to about 2/3 of that. So we've already seen a little bit of an unwinding, if you will, of the property market bubble there. And when you also put into context how large Evergrande is versus the broader real estate market, and even the top 10 to 20 players account for just under 1/3 of the marketplace there, we don't think that it is a Lehman moment in that kind of vernacular at all.
Chris, do you think it's helpful to even ask the question, is it a Lehman moment, when this is clearly so different and it poses its own risks?
No, I don't think so. I think you have to look at it for what it is. And there, as Laurie mentioned, there is a multitude of things going on. If you look at China, it's not just about Evergrande. It's also about what's happening with the tech companies. It's what's happening with the heavy hand of the government. In the States, what we have to deal with is we have to deal with the debt ceiling. We have to look at tomorrow with the tapering. We have issues with port congestion and inflation. So we have to look at it for what it is. And what it is a very leveraged situation, a very difficult situation. But where is that contagion going to be and how long is that? Is it going to be short and sweet, or is it going to be something that's much longer? And we think it's going to be something that's short but sweet.
Here's the quote from Aberdeen. They say the following: there will be uncertainty and volatility in the near term, but outside of Evergrande, policymakers will be able to engineer some sort of recovery from this. That is basically the baseline view for a lot of people on Wall Street worldwide. Let's bring in Bloomberg's Damien Sassari, joined us now from the Greenwich Forum in Greenwich, Connecticut. Damien, let's start there. Where the risk lies here, through the real economy or through the financial channel?
I think it's the financial channel, clearly, Jonathan. And I think this has very, very little to do with Evergrande and far more to do with the risk of a policy error on the part of the PBOC. I think what the market is trying to do, and it really kind of, Chris points it out really well, this is all about the uncertainty related to the crackdown on big tech, the crackdown on and everything that Beijing's been putting forth here. I think really for me, China needs to cut rates. They need to stimulate. If you look at the combined big four central bank balance sheets, I'm talking the Fed, ECB, the BOJ, and the PBOC, that stimulus is going down. It's decelerating and it's declining. I mean, it's gone from 20 to 30 trillion in just a year. But now what the markets need is more stimulus out of China, and the uncertainty surrounding that is what's driving all the price action we've seen over the better part of the last 24 hours.
Damien, do you think that's what the market, the economy needs? Do you think we'll actually get it? Or do we have to just get used to a world in China where GDP is going to 5, maybe lower?
Well, if we don't get it, Jonathan, then that Lehman moment that everybody's saying won't happen will happen, because this is definitely systemic to the Chinese economy. If they just try to write this off and let Evergrande fail, the blowback on the property sector will be enormous. And then the blowback on the back of banks like Minsheng and ABC, ICBC, who have lent funds to Evergrande. I mean, it's going to be, HSBC, who has CRE exposure. I mean, you saw CDS for HSBC is up 16% overnight. So, all of that blowback will happen if Beijing doesn't step to the fore here and the PBOC doesn't ride to the rescue, in my opinion.
Good to catch up. You've been on top of the story the last few months with us. We appreciate it. We'll continue to stay on top of it. Couple of pit stops this week for the Evergrande story. Yesterday, some interest was due on bank loans. We can confirm here at Bloomberg that payment was missed. On to Thursday, where some interest is due on a couple of bonds. We'll stay on top of that story as well. And the question we keep asking, two risks here. One's financial, the other's economic. And they kind of are the same thing. This is the view from Bank of America going forward from here, all the way out to 2023. I'm interested in the growth forecast for next year. That gets the chop from 6% down to 5.3, from the low 6s down to 5.3. I want to bring you back in, Laurie, and understand from your perspective how you plug that in. 5% GDP growth next year in China. Even if they clean up the Evergrande mess, what happens here with real growth and what it means for your asset allocation decisions?
Well, certainly China is mostly still geared to the world economic growth prospects. And there again, while it's important to talk about Evergrande and the property market, it's more impactful to talk about the Delta variant and how we're going to see economic trajectories go from here. And I guess we've been on the more cautious or conservative side of that. We thought that 2021 would be a good recovery year, but we actually thought that it would extend into 2022 because we weren't as enthusiastic about just this one-way ticket to recovery. We did expect that there would be some setbacks along the way. So again, it's part of this broader picture of, slowing, but still very good sustainable growth. And China growing at 5 or 6% is still healthy growth and actually has an upside if we start to see broader economic recovery.
Chris, would you go with that? Would you agree?
So if you look at, let's just talk about the U.S. for a second. If you look at the U.S., what the U.S. exports to China, it's not a ton. And more specifically, it's a lot of ag, which is pretty stable. Second thing, and let's roll this back 20 years. 20 years ago, we had a LATAM crisis. We had an Argentinian crisis. A lot of the large cap banks had multiples of the exposure to LATAM that they do to China at this point in time. When we looked at the numbers, our bank team did a really nice job at looking at the numbers and exposure to China. And it's less than 2% for many of the major financial institutions of total assets. That is not what I consider material. And so as a result, yes, we can have capital market contagion. If something really bad happens in China, expect U.S. equity markets to go down. But we just don't think that that flows over into the economy. And that's the most important thing. Because if it does flow into the economy, then we have a much bigger problem. If it's a capital market issue, now it's just where's the proper price for risk and what's the level. And I think that's the spot that we're in right now.
this week, just getting started. Still got to get to that Fed decision tomorrow. Let's bring in Abigail Doolittle for more. Hey, Abby.
Hey there, John. Well, what a difference a day makes, because just 24 hours ago, we were looking at U.S. equity futures down 1.5%, oil plunging, bonds up, very, very defensive, as you were saying. Today, it's the opposite story. We have stock futures higher, we have oil higher, and we also have bonds just about flat right now. So a risk-on, offensive idea here as NASDAQ 100 futures are outperformed by the Russell 2000, so a bit of that reflation trade. If we take a look at a two-day chart of the S&P 500, we will see the roller coaster ride that this week has been so far. At one point, John, as you know, after the S&P 500 sliced through the support of the 50-day moving average, it was down nearly 3%, headed to its worst day since October of last year. But on the 100-day moving average, those intermediate-term dip buyers, they stepped up, supported the index, now down just about 1% on the week. Net, though, this means we still don't have that 5% pullback that so many folks are looking for. If that holds through today, day 221 without a 5% pullback, or more roughly 10 calendar months without that healthy correction pullback that so many strategists want, John.
Abby, thank you. JP Morgan saying buy it. This from Marko Kolanovic. The market sell-off that escalated overnight, we believe, is primarily driven by technical selling flows in an environment of poor liquidity and overreaction of discretionary traders to perceived risks. Chris, I don't usually do this. Forgive me for asking you. Can you translate that from JP Morgan and Marko Kolanovic? What is Marko talking about? Yeah. The market sell-off that escalated overnight, we believe, is primarily driven by technical selling flows in an environment of poor liquidity and overreaction of discretionary traders to perceived risk. What does that mean, Chris?
I'll see if I can unpack that as best I can. So the first thing you have to understand is mainland China and Japan were closed. So there was a lot less liquidity. If you wanted to express your liquidity in that region, you had to do it in the Hang Seng. Hang Seng was down 3% yesterday, and it is in a correction for the year. Part of that, as we alluded to before, is related to some of the issues with China and specifically with tech. What we're hearing from a lot of discretionary traders is China or Chinese stocks and Chinese ETFs are not investable. What they're saying is we can't handicap the political. We don't know what Xi is going to do. It is driving down a lot of their large cap tech stocks, and we don't know where the bottom is because this is unprecedented. And then what you have is once things get moving, you have the creation of forced sellers. And so you tie it all together. You have issues with China and large cap tech. You have issues with one market being open and liquidity problems. And then you have the overarching issue is there are people out there that are very momentum oriented. And when the momentum breaks, they sell into weakness.
Marko says thank you. I assume he says thank you. Anyway, Marko Kolanovic over at JP Morgan. Chris is going to stick with us. Chris Harvey from Wells Fargo, together with Laurie Heinel of State Street. Luca Paolini of Pictet's going to drop by as well. Up next on the program, we've got to get to the Federal Reserve. There is a decision tomorrow, and we've hardly discussed it on this program through the last 24 hours. Micah McKee is going to bring you some highlights to look for up next on the show. 18 minutes away from your opening bell. This bounce fades a little bit, up 23 on the S&P, advancing just 0.5%. From a beautiful New York this morning. Good morning. This is Bloomberg.
After 16 years in power, actually, remains one of the most popular, if not the most popular, German politician ever. Who's the right person to fill those shoes?
Well, whoever is going to be filling those shoes is going to have a very hard time. Look, as the Merkel era ends, most of the certainties which we Germans, during 16 years of Merkel, tended to take as forever are evaporating before our eyes. The eternal assurance of the United States always protecting us. That's gone out with Donald Trump. The certainty that we will build an ever closer union, the EU, has gone out of the window with Brexit.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Wednesday, Bloomberg surveillance. The Fed decides. When will tapering begin? How does the Fed see the Delta variant economy? Coverage begins at 1:30 p.m. Eastern on Bloomberg Television and Radio.
We have to get through, the Evergrande situation. We have to get through the FOMC tomorrow to see, is the Fed going to end up being a little more hawkish, as some people fear, or do they kind of toe the line? Really, the next 10 days to 2 weeks, we see a lot of potential head risks or headline risks that we can get through.
These issues are piling up and piling up and piling up. Investors looking ahead to the Fed with all of these issues piling up. We caught up with the former Fed president, Bill Dudley of the New York Fed, warning of inflation risk if the central bank doesn't make a move.
Well, there's a risk to their credibility because, one, inflation's higher for longer. Two, inflation expectations are starting to rise. And three, they've sort of bound themselves in terms of, when they can actually raise rates. They said they're not going to raise rates at all until they've hit 2% inflation, hit full employment, and are confident inflation is going to stay above 2% in the future. If inflation expectations get unanchored, that's going to push inflation up even before we get to maximum sustainable employment. So they could be in a tough spot.
Are they in a tough spot already? Joining us now is Michael McKee. Morning, Mike.
Morning, John. And this is not going to be about the Fed statement. This is going to be about Jay Powell and what he says in his press conference after the release of the statement. The first problem that the Fed has is, as Bill Dudley was talking about, the economy. What are they going to say about inflation? Are they going to talk about it in danger terms or stick to the transitory line? And what does that mean for how hawkish they might be about when they might start raising rates? And then you can see growth there falling off. That is the Atlanta Fed measure. And do they suggest there is a stagflation underway, or do they talk about the fact that it might be just a temporary pause because of COVID? They have a second problem that they have to deal with, and this will definitely come up in the news conference, is what do they say about the conflicts of interest that seem to have come forward from their various members of the Fed buying and selling securities? Does the Fed have a real problem, or is Jay Powell's review going to take care of it? What's he going to say about that? And then the third problem, and the big issue, of course, is what does he say about tapering? I mean, you take a look at this, and on the far left-hand side, you can see there the first taper after QE3. The T in the middle of the circle is when Ben Bernanke said, we're thinking about it, and we had the taper tantrum. You can see what happened to the 10-year yield. And then below that, you can see the box where they did taper. It took about a year. How long is the Fed going to signal it will taper for this time, given that, as Bill Dudley said, investors think the Fed won't raise rates until they are done tapering? So it's going to be a question of how Jay Powell explains it all to Wall Street.
Looking forward to your coverage tomorrow, Mike. As always, Michael McKee will be joining Tom Keene and myself for some special Fed coverage for you tomorrow afternoon on Bloomberg TV and on Bloomberg Radio. Still with us, Luca Paolini of Pictet is going to join us now alongside Laurie Heinel and Chris Harvey. Luca, straight to you, sir. What are you expecting from the Fed tomorrow, if anything at all?
I think that we confirmed that U.S. economy is solid, and I think they want to make a step. I think the announcement for a taper is probably not going to come before November and December, with a taper, an implementation probably in January. I don't think that the Fed is going to change the message just because the S&P is down 5. So I think that the Fed will make kind of a pre-announcement with the actual tapering starting early next year.
You know, some people think they would change the message based on the S&P being down 5, but Luca, we can leave that one to one side. Chris Harvey, do you think they will just stay on message, stay on the path they've been on, evolve the language a little bit and tee up November?
John, I think that's spot on. I don't think they change the language. I don't think they do anything revolutionary. And I think if they don't say taper, which I don't think they're going to, the market will probably see this as slightly dovish. Until they say taper, I think the market's still very happy. Market loves accommodation. And so I think this will be a small positive tomorrow, but don't expect much language change.
Laurie, are you assuming the same thing?
Well, we thought it was notable that Chairman Powell indicated his own support for taper during his Jackson Hole speech. He certainly didn't have to go that far in terms of indicating his own support. So we think that they're anxious to get at it, but we do think that tomorrow is not the day, that the debt ceiling kind of looming behind us is a little bit of a challenge, and that was true before yesterday's sell-off. So we think it's more likely a November event.
Laurie, a number of months ago, I asked Vice Chairman Clarida how he would know if he was wrong on the transitory call. And he gave me a pretty good answer. He said, by the end of the year, we'll have a better idea at the turn of the year. How do you think they need to develop the message on inflation, given the numbers that are still coming through?
Well, look, their party line is that these are transitory forces, and we would echo a lot of that. I mean, certainly if you look at the sort of sell side pressures there, we've had a lot of supply constraints. We've had certainly pent-up demand that's leading to certain shortages in certain areas. So we do think that there are pressures there, but we do see them as primarily transitory. And you haven't seen other things like inflation expectations tick up markedly. They've ticked up a little bit, but nothing that yet gives us concern that we're dealing with something more systemic.
Luca, what about you? Your view on that?
Well, I think that inflation is not completely transitory. I think the situation now is such that there is a lot of money around. Supply constraints are inflationary. We don't know if the supply constraint will be actually transitory. So I think there is a genuine risk of inflation. At the same time, we have seen the latest reading going probably in the right direction. So I think there is probably momentum is fading, but I think the inflationary risks, I think, continue to be high, and I think they will not go away in the next few months.
What does that mean for your equity positioning then, Luca?
Well, what you have seen is a significant change because we see less growth and more inflation. We see valuation still very high. We see potentially even a peak in earnings momentum, and then obviously the risk coming from China. So I think this is the time to be a little bit more cautious. Not the time to panic, but to be a little bit more cautious and be a little bit more defensive in the sector allocation. That's what we are doing right now.
Chris, I've got a pretty good idea that you're on the other side of that. Why is that, Chris?
No, we're not on the other side of that. What I would say is we do want to anchor the portfolio with some low volatility and some more defensive, but we also want to take on more cyclicality, more higher COVID beta. At the end of the day, what we see is in my career, I've never seen the kind of pricing power that we have today. And until you get the inventory situation resolved, which you're not going to do anytime soon, you're going to continue to have pricing power. And then if you look at owner equivalent rent, that doesn't look very good as we go forward. So I don't see how this is transitory. Now, my definition of my time horizon of transitory is probably much shorter than Jay Powell's. His is probably 12, 24, 36 months. Mine is 6 to 12 months, and this is not going to be transitory in the next 6 to 12 months.
For a lot of Fed watchers, Chris, as you know, the chairman's come up with his own definition, and maybe it's a little bit too loose. Laurie Heinel, we're going to tease out some of the market calls from you guys as we work our way through the opening bell. I just wanted to sit on your small caps call for a little bit. That's part of the mix for you, Laurie. It's been difficult since spring. Why stick with it?
Well, look, we've been sort of barbelled. So we've liked large cap U.S. growth. That's an area that's continued to do well, and we think will continue to do well. But we also see some rebound in some of the cyclical sectors, and that's more well represented in the small cap position. And we also have been increasingly interested in Europe, where there, again, valuations are more attractive. We think that next year could actually see a premium in terms of European growth and potentially European risk assets. So we've been trying to pick our spots sort of around the different equity regimes and find places where we think there's good value and potentially good upside.
Europe feels brave given what's happening in China. Let's tease that one out around the opening bell. The guys are going to be sticking with us. Laurie Heinel, Luca Paolini, and Chris Harvey as well. Coming up on the program, the morning calls, and later, China contagion hammering mega cap tech stocks. The 5 biggest US companies shedding more than $500 billion since the Nasdaq's peak in early September. That conversation just around the corner. Equity futures fading here. The S&P up by 0.4%, well off the highs from early this morning. We advance around about 20 points. From New York, this is Bloomberg. bounce is fading just a little bit. 5 minutes out from the opening bell, we're still positive, up 0.4%, but off the highs of the session. On the S&P, on the Nasdaq as well, we advanced there just 0.4%. That's the price action. Let's get you some morning calls. First up with Morgan Stanley, downgrading General Mills to underweight, $51 price target. The analyst expecting slower sales growth amid weakening COVID-related tailwinds and rising commodity prices. We're negative there, 0.7% to 58.33. The second call from Piper Sandler, downgrading Big Lots to neutral, a $50 price target. The analyst seeing a number of macro headwinds impacting the retailer's fundamentals. Negative there, 1.54%. And your third and final call from Jefferies, upgrading Steve Madden to a buy, highlighting management's recent steps to build up inventory and avoid supply chain disruptions. That stock positive by almost 5%. Up next, the opening bell, the industrials and mega cap tech stocks looking to shake off lingering China concerns after some big declines. That conversation next. Your opening bell just around the corner from New York City. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Following the biggest one-day drop since May, will this bounce hold? From New York City this morning, good morning. Going into the opening bell, equity futures up 0.6%, up 24 points on the S&P 500, going into the opening bell in New York City. The opening bell ring and switch out the board and get to the bond market. Treasuries look a little something like this. Your 10-year, 130.74. Yields were higher by a couple of basis points this morning. We erased that. Euro dollar not doing much either, 117.33. Positive there, not even a tenth. Erasing some of the gains as well in crude, $70.87. on crude, up by 0.8%. We open up by about 1/3 of 1% on the S&P. Let's get you some moves at the market desk. Here's Abby.
John, well, the dip buyers certainly are out after the 100-day moving average intermediate support held yesterday, and the reflationary trade is in charge today, or in charge in part. If we take a look at some of the energy movers, this was the worst sector yesterday, down more than 3%. Today we have ExxonMobil up 1.4%, Occidental up 2.4%. So those energy traders want in. That's the case for banks too. And what makes that interesting, John, you were just highlighting, banks basically, yields basically flat. Even so, one of yesterday's other worst sectors bouncing today here on the open. Let's extend it into technology because we're going to see gains there as well for Apple and Microsoft. So really broad breadth in terms of what's working. And then finally, two of the stocks that did work yesterday in that sell-off, American Airlines and Delta Airlines. This, of course, is the White House has revoked the travel ban so long as travelers show proof of vaccination. Overall, John, it is green, green, green on the screen.
For how long, Abby? For how long? Thank you. About a minute in. Will this pop hold? We are positive 0.4%, up by about 17 points. To bring you the industry breakdown, Abby gave you some clues there. Energy top of the pile, up by 1.3%. Utilities bottom of the pile, as you might expect, up just 0.1%. Middle of the pack, information technology advanced at 0.25%. IT and big tech had a really rough time of it over the last couple of days, looking to rebound after closing at its lowest level in a month. The 5 biggest US companies shedding more than $500 billion since the NASDAQ 100 peaked just a couple of weeks back on September 7th. With us now for more, Katie Lyons. Hey, Kaylee.
Hey, John. Well, we have to keep in mind that these are all very, very richly valued companies. And in a market where the bears have been concerned about valuation for some time, yesterday may have just been an excuse to sell things off, even though these names don't necessarily have anything to do directly related with China. But there are other stocks here in the U.S. that do, one being Wynn Resorts, the worst performer in the S&P 500 over the last week as China looks to crack down on casino operators in Macau, a market in which Wynn gets about 70% of its revenue. It's down about 10.5% over the last 5 days. You also have metals and mining down about 5.6%. You have the concern around commodity production in China and the crackdown on steel production specifically. The list goes on, John. And of course, hanging over all of it is the story with China Evergrande and the broader economic slowdown happening in the country. And for that reason, we have seen dramatic underperformance from Chinese equities relative to those in the U.S. The S&P 500 up about 32% over the last year. The MSCI China Index, on the other hand, down the better part of 10%. And the question is whether the pain there starts to bleed further across financial markets elsewhere across the world. And that doesn't just go for equity markets, John. You have to factor in credit here as well. And when you look at the Asia dollar-denominated high-yield debt index, more than 1/3 of it, 35%, is real estate. So passive funds invested in it are heavily exposed to risk in the property sector, which looks more and more fragile as this Evergrande story continues, John.
Kaylee, thank you. The question you ask is the question that Chris Harvey of Wells Fargo has tried to answer. He says the following: it's been our experience that risk flare-ups typically do not disappear overnight. The capital market stress could take 1 to 2 weeks to wash through the system and could be rather gappy. Technicals will provide a decent guide, and we're watching credit markets as well. Lucky to have Chris with us alongside Laurie Heinel and Luca Paolini. Chris, build on that for us. Why a couple of weeks? I caught up with Mike Wilson of Morgan Stanley, went through all the issues with me and said this could take a couple of months.
No, I don't, because we think this is a capital markets issue. We don't think this is an economic issue. And typically when you have a capital markets issue, it plays out, it's rather severe, but it plays out rather quickly. And so we got to the 100-day yesterday, we broke through it, we bounced. We think we do think we retest that level, and maybe we go through it again. There is a lot on the plate of the U.S. equity investor, whether it's taper, whether it's debt ceiling, or whether it's earnings. But ultimately, this just comes down to whether this is a financial issue or a capital markets issue or an economics issue. And to us, this is not an economics issue.
Laurie, your take on that, how long this could take to work through?
Well, look, it's really hard to tell whether there'll be other legs to this story. We, again, don't think that this is going to be a long live story. We think that China's taking steps already to deal with the Evergrande issue. And as I mentioned on the earlier part of the program, this is not something that we believe is going to be systemic. More important will be some of these other looming things, the debt ceiling, the Fed taper, the COVID trajectory. Those things are much more important for how the market sort of ends the year.
I want to understand how you all manage the China risk through European equities. Luca, I want to come to you on that. based out of Europe. I think it's an important conversation to have. A lot of people have come on this program over the last couple of months and said it's a favorite of theirs. They want to increase their position in Europe. They give me the reasons why. I look to China right now, and as a base case for many people, it's going to be lower growth. How do you plug that through to a European overweight, a constructive view on European equities?
I think the case for Europe is pretty simple right now, because you have pretty solid growth. If you look at business confidence is one. You see actually much less inflation risk that you see in the US. You see a significant acceleration in earnings, and valuation is attractive. Now, Europe being Europe, I think most of the time it's better to be only technically overweight. But I think the case for Europe is there. And also, let's not forget that Europe will not have the same fiscal cliff the US will have next year. So you put everything together, I think Europe will well positioned for the next 3 to 6 months.
You've added some exposure to China as well. Luca, we missed you at the top of the hour. The floor is yours, sir. Why?
I think it's important to highlight this, that when you look at China, of course, there is this potential credit event about Evergrande. But I think what we have been seeing is a significant deterioration in the economic conditions. We have seen a tightening of financial conditions. So we are not actually kind of bullish in the very short term, but we believe we're not too far away from a buying opportunity. And this buying opportunity will happen when the Chinese central banks will take us clear steps in favor of easing monetary condition. I think we are not yet there, but I think we are getting ready to add to our position in China in the next few weeks.
Laurie, can I just come back to you on your European position? Why maintain that position given what's happening around us right now?
Well, look, we think that Europe is actually in a pretty good spot. You know, valuations are relatively attractive. You have accommodative Fed policy. You've had the vaccinations rolled out there very aggressively, and that's putting them into a better place, we think, as we sort of enter the winter months. And, you know, finally, you're starting to see some fiscal opportunities. So we think that all things are firing right now, and then the makeup of the index there is much more geared to cyclical. So as we do see an elongated recovery, we think that Europe is a big beneficiary.
Chris, you've got a US focus. You're listening to this conversation. What do you make of it?
So what I would chime in, I'll leave that to the other guests, but one of the things I will point out, U.S. financials, if you look at U.S. financials, you look at their balance sheets, you look at their exposure to China, they have very little. If you look at the quality of them, the quality is quite high. They pulled back over the last couple of days. And I think if you want to invest in something that's more cyclical, that's a little bit higher risk, U.S. financials are a place to put your money to work.
Chris, was that a bond market play? What was that yesterday? More than anything, just pure de-risking. What did you make of it?
So I think the Evergrande situation became acute very quickly. I think a lot of investors were looking for the government to say something, make some sort of gesture. They did not. That was exacerbated by the fact that several of the markets were closed and you had to express your views in a lot less liquid market. And then what happened in the U.S. credit market is we did expect to see some announcements. We've had a significant amount of issuance, I think $120 billion since Labor Day. That market's been very open, but we did not get those announcements. That's not unusual, right? I think a lot of these issuers are looking for more stable conditions, and when those stable conditions come back. But it is something to watch, and it is something to monitor.
Chris, always good to catch up, sir. Chris Harvey of Wells Fargo, together with Laurie Heinel of State Street. Laurie, thank you to you and to Luca Paolini out of Europe. Luca Paolini from PigTech. Your equity market, about 9-10 minutes in, advancing 0.6% on the S&P. Similar move on the NASDAQ. The bounce sticks for now. Let's get you some movers. Here's Abby.
Yeah, those dip buyers are out, at least right now, John, in the first few minutes of trading, and the reflationary trade is back on. Yesterday's worst sectors among the top sectors today. If we start out with some of the energy movers, we are going to see that big energy is dominating, with ConocoPhillips in particular up 2.4%, ExxonMobil up 0.9% in sympathy with oil. We also have the fertilizer companies higher, Mosaic one example, up 1.5%, and then Newmont Mining. The miners had gotten hit big time yesterday. Those higher too. So materials, another top sector, or in the middle of the pack, I should say. Turning to a really beaten up sector where we do have some strength, and this is why consumer discretionary is one of the top sectors on the day. Take a look at the casinos, John. We do see some strength here. MGM Resorts, Wynn Resorts, Caesars Entertainment, all are looking past, at least right now, fears of some sort of regulatory crackdown over in Macau. Seeing, again, it's redundant, but it is true on the day, the dip buyers are out, John.
Abby, there's so much to get through this week. There really is. Abby, thank you so much. About 10 minutes in, the session's young. We're up 0.6% on the S&P. Tomorrow is a Fed decision. On to Thursday, we have some interest payments due from Evergrande bonds, a couple of them. And then we need to hear from China, Chinese authorities, what the solution looks like. Chinese markets, I understand, reopen tomorrow. Coming up, Tom Keene this morning was a lonely man. Now he's got some company. He sits down for an exclusive conversation with Orlando Bravo, the co-founder and managing partner at Thoma Bravo. That conversation will be happening very shortly. From New York City, about 10, 11 minutes into the session, the bounce back from the biggest one-day drop since May looks like this. Up 0.5% on the S&P 500. From New York City, this is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
There is just a lot of demand right now for products, whether those be items for our home office or for backyard entertainment. This has been a consistent issue for the past year or so throughout various lockdowns. The global supply chain is made up of ships and trains and trucks, and it's designed for predictable patterns of demand, which is the exact opposite of what we have right now. A lot of uncertainty about whether certain economies are going to be open or closed based on the outbreaks that they're having. So we're just seeing a lot of confusion, a lot of chaos, and a lot of uncertainty disrupt the whole system. The auto industry is very reliant on semiconductors, these memory chips that are in basically everything we buy that has sort of an electronic component to it. And they come from certain economies in Asia, like Taiwan, where they're having trouble meeting the demand. The supply chain issues are going to be around as long as you think the virus is going to be around. First or second quarter of 2022 is when a lot of people see the normalizing of all the shipping and transportation disruptions that we're seeing. But if they don't, we might be dealing with this for another year or two or three.
We are about 14, 15 minutes into the session. Here's the price action for you. Equities with a little bounce on the S&P, up 0.5%. On the Nasdaq, up by a similar amount. On the sector breakdown, top of the pile, healthcare, believe it or not. Consumer staples up there too, up by 0.8%. Industrials, basically unchanged. Materials only up about 1/3%. Europe doing okay after a really ugly session yesterday. Switch up the board and let's take a quick look at the bond market and elsewhere. Your 10-year Treasury, 130.57. Yields now lower on the session. They were higher by a couple of basis points. We fade that move just a little bit. I'm pleased to say that we can now head over to the Greenwich Economic Forum over in Connecticut, where we can catch up with my good friend and colleague, Tom Keene, who is standing by with a very special guest.
Good morning, everyone, on Bloomberg Television, Bloomberg Radio worldwide, for what I hope is a 2-hour interview. We spoke with Nora Rabini, an hour interview. Ray Dalio walked off the set. We couldn't do a 2-hour interview. We're going to do that now. We're going to squeeze it in with Orlando Bravo. This is the Greenwich Economic Forum. It's a sort of a coming out of the pandemic meeting. Real people here this time around. Orlando Bravo, Thoma Bravo, and of course it is about the development of capital for technology and the huge success of Thoma Cressy onto Thoma Bravo. We're thrilled you're here today. I want to get real with you, and that is the symbolisms of exiting the pandemic. And for you as a legit ex-tennis player, it was you going to the U.S. Open and seeing New York City light up.
Well, first, thank you for having me, Tom, and it's really good to see you in person here by the water. It's really, really nice. And the U.S. Open, what a magnificent event. After 2 years of not being live tennis, the crowds were there, the players were fired up, and it was the best U.S. Open I've been to ever.
It speaks to the coming out of the pandemic. Yes, horrific statistics, the deaths today mirroring 1918 and such. But what are the symbols you see now in investment and in private equity development where you can say we're getting beyond this natural disaster?
Creativity. I see private equity firms, investors, and companies reflecting on what worked, what didn't, and how we're going to work and live going forward. And it's going to be better. For example, the hybrid world is going to be a lot better than just the in-person or the remote work. And companies are going to be able to do that more efficiently, and people are going to be able to have better lives and balance their families and their work lives as well.
A major theme, which I've emphasized in the last 60 days, is strategists from a wide number of banks who say, look, the street has it wrong, the gloom has it wrong, technology is leading. It's easy to say that when you're an equity strategist. As a guy in the trenches, what does the new technology look like versus the stereotypes we hold?
The new technology is totally different. See, what happens is software, if you take that as a segment of technology, is not an industry anymore. It used to be when it was on premise, when there was no cloud computing, when there was no SaaS. Now software is becoming the entire business of companies.
So are you looking out for the next Adobe? Is that what Thoma Bravo is essentially doing 24/7?
We're 24/7 buying and partnering with the market leaders who are leading digital transformation in their industries. And then secondly, we're partnering with the infrastructure software providers that are enabling this new cloud world. And then third, and really importantly, we're partnering with the leading cybersecurity companies that are protecting this new world and ecosystem.
How does traditional business transition to the Orlando Bravo view? They've got offices, hallways, they're going to lunch in Midtown Manhattan, around the world, in your Miami as well. How do those, the fossils from another time and place, come over to the world you perceive in software?
Culture and leadership. You really have to understand young people, what drives them.
Good. We're extending this interview because I don't understand young people. Continue.
Young people, you have to understand they're much more advanced. They're more philanthropic. They care more about what their job means to the world. So you have to build culture on the one hand and adapt to that. And at the same time, you have to have leadership that gets it, that gets the memo that if they don't immediately look at digital transformation, they're going to fall behind.
On radio and TV, we said good morning to Tim Cook. He was up in front of Apple employees a couple days ago. It didn't go well. They were upset about certain themes and topics. How would you recommend to the great tech giants that they adapt and adjust to the new youth of America? I love this phrase, the geriatric millennials. How do they adapt to them?
Run decentralized organizations where you build a culture of trust, where you can delegate responsibility and authority. That way, the young and future leaders that we have will have broader jobs, broader roles, and therefore they can be more creative in doing that.
How do you do that with command and control? I mean, how did Hewlett and Packard in a garage 40 years ago, 50 years ago, Did they do that? Did they delegate in that way?
Command and control does not work anymore. It's illusory control. You may feel like you are in control when you see all of your employees in the office, but you're really not. Once again, it's a culture of trust and delegation, and that's the new way businesses will be run.
Just because of time, I want to get to this. Is there a partition in investment return? Have you adjusted a perceived 7-year internal rate of return for the future? Or do you see the same old great news that Thoma Bravo has had for decades? Do you see it just because of your execution excellence, or do you have to bring down expected returns?
I cannot talk about returns because we're on live TV, and I'm not allowed as a private equity firm to talk about it. Now, what I can tell you is the fundamentals of the companies that we're investing in have never, ever been better. And our ability at Thoma Bravo to improve operations of companies only in partnership with existing management. Think about delegation and culture that way, that remains intact.
I need to take the rest of our time and speak about your Puerto Rico and your true investment into Miami. You've done your work in New York with Sloan Kettering and others, but give us that unique linkage right now of Miami and an expanding southern Florida with all of Latin America. What does the new relationship look like?
Well, we're a creative young firm. And we knew we needed an office on the East Coast. So where do we go? Miami. Miami is a very diverse society. It's a growing place, and it's a place where young entrepreneurs can make a big difference and build their own community and also be celebrated as capitalists. So we're really excited about that. Of course, for me personally, it's close to Puerto Rico, where
you're talking your own book.
Exactly.
Okay, what does Manhattan do? Looking down 6th Avenue, UBS, Alliance Bernstein, and the rest, they're afraid their clients, they're afraid their employees will move south because of tax law. Do you predict that's going to occur?
Somewhat, but not too much, because New York City is the best city in the world. It really is. I feel all these movements are additive. Think about it, San Francisco and New York City, how many more knowledge workers can you have? How many more new buildings can you build? Artists were being driven out. Other parts of society were being marginalized. So this is an additive, positive movement to those cities.
I need you to give us an update on your Puerto Rico, the horrific natural disasters we've seen. You've obviously provided major philanthropy. There are all these stereotypes, the 51st state debate. The knowledge base of so many people is one song, Despacito, and the rest of it. Straighten us out right now about the new and future Puerto Rico.
What I'm seeing in Puerto Rico now is talking about young leaders, the young leaders of family businesses and young leaders that are entrepreneurs are very different than the prior generation. They really deeply care about integrating a society. Puerto Rico is one of the most unequal places in terms of income in the world. If it was a country, it would rank in the top 5. And I am seeing the young business community caring about that and looking to change that.
How do you address crime? Not corruption, but how do you address every stereotype I've heard of Puerto Rico in crime? How do you fix that for the children of Puerto Rico in the future?
Crime is a byproduct of poverty.
Yes.
It's not like people are bad. So you have to address income inequality and poverty. And we do that in our foundation in a big way. That is the mission of our foundation, is provide opportunities for talented young adults that otherwise wouldn't have one. And the poverty rate is just too high. Now, the system has to change, the culture has to change, and businesses have to get involved.
The image now of too many Haitians desperate beneath the bridges of our borders. What is your advice to the Biden administration? I've had landmark interviews with Carlos Gutierrez as one example about what to do. It's a nation's angst. What's your recommendation on immigration policy for the Biden administration?
When it is an issue to the level that it has risen to, which is a humanitarian crisis, you have to open your borders to those people that are suffering. I mean, we live in the world together. Of course, the constituents are American citizens that voted you to be president, but it's a humanitarian crisis. And by the way, this is going on throughout the Caribbean, in Cuba, in Haiti,